Hi guys, this video is very important for every CA Inter student aspiring for May 23 examinations. Now, uh, just 2 days ago on 23rd December, the institute has given an announcement regarding applicability of study material for May 2023 examination. Like if you look at that, that notification, before this, I have got many questions from few students regarding, sir, what material is applicable for May 23 examinations. The ICA website do not contain any specific material for May 23 examination and November 23 examination. So can you give a clarification on that? So, and that's why I'm doing this video. And luckily, institute has also given a clarification announcement in this regard. Now, look at everyone knows that in the 2023 year, the institute is going to announce the upcoming proposed scheme of education and training. The new scheme, we are calling it as proposed scheme, in fact. Don't ask me the question about, sir, from when new scheme is applicable, from when the examination will be conducted for the first time. To best of my knowledge, 20% probability. 20% probability that new scheme will be implemented in November 23 examination, 80% probability that the new scheme will be implemented in May 2024. Okay, so one one clue which I have got is very recently the institute has finalized the study materials, everything. It is just waiting for the winter session parliament approval. So that's what I heard. I'm not exactly sure about that. But anyhow, so hardly for November 23 examination, there is only 1/4 probability that the new or proposed scheme will apply. So whoever is planning for May 23 examinations, you ignore about new scheme. Forget about new scheme. Your target is May 23, right? Then watch this video till the end without missing. Okay, now. So in the year 2022, the institute has not given any new material. They have not released any new material except for income tax. Only for income tax in May 2022 month, the institute has released a new income tax update with assessment year 2023-2024. Like everyone knows, right? Before that, institute book will have assessment year of 22-23. What every year institute will do in income tax, especially the assessment years, they'll change. Especially this will have a huge impact in the chapter called capital gains, because in capital gains the cost inflation index number is different for every financial year, nothing but for every assessment year. Now, so especially our register subscription students, subject wise students, regular students, and many others who are following our marathon classes are asking, sir, should we have to take a printout of ICI new material? Should we have to take completely new classes? Should we take completely new material? So this is the question which everyone is asking. So for that, what my clarification is, uh, we have our faculty, tax faculty, namely Samba Shiva sir. What we have done very recently is we have compiled a material called amendments material. We have compiled a material, nothing but amendment material. Like most of the students who have given November 22 exams or May 22 exams would have prepared taxation subject, especially income tax, based on assessment year 22-23. Whereas the upcoming May 23, the assessment year is going to change to which year? Assessment year 23 and assessment year 24. So this is the new assessment year which is applicable. At the same time, Finance Act 2023, nothing but what? Sorry, Finance Act 2022. What is the Finance Act? Finance Act 2022 is applicable for May 23 examinations. Now, whatever amendments that came into picture in this Finance Act 2022, for all those amendments, nothing but what we did, institute has old edition, that is October 2021 edition of income tax. May 2022 institute have given new edition, right? Yes or no? Between these two, we have compared page by page, section by section, subsection by subsection, and highlighted the differences and prepared a material called amendments material. Getting it? And this material can be downloaded in Sreshta app. There is an app called Sreshta for CA and CMA. There is an application called Sreshta for CA and CMA. You will find with this white logo in the Google Play Store. You just open that Google Play Store, download this application, log in, go to taxation subject. Inside that, the material is free for download. Amendments material is free for download. You just download it. Okay. Now, what is this video is about? This video, I'm giving you a clarification, and also what the next 5 hours is nothing but amendments explanation by our expert faculty Samashiva sir. Getting it? It's a very detailed amendment. So the bottom line, what you have to do, if you have already taken the printout, or if you have already using some taxation book earlier, belonging to earlier, do you need to buy new book again? Do you need to take a new book or new class? Nothing, no need. Getting it? Because this time amendments were very few, hardly 20 pages. That's what I told, right? Entire amendments class is hardly 3.5 hours, some 2 hours. Capital gain problems also we recomputed. What we did in capital gains, we recomputed capital gain problems with new index number. Getting it? So entire that amendment video we are attaching here. So the next 5 hours is the nothing but amendments video. So this is an important clarification which you need to note. So simple, what is the summary of this video? If you have already taken, if you have already been using some tax material, income tax material, which is originally applicable for May 22, originally applicable for November 22, for May 2023, do you need to take up once again completely new classes? Not required. You just go through the amendments video, whatever we are providing you, that will be enough. Especially if you are a Sreshta student, if you have already taken our subscription course, or regular course, or income tax subject wise course, what you have to do, watch those videos. After completion, after finishing watching those videos, immediately you watch this amendments video. Don't watch amendments right now. Especially if you are a Sreshta student, don't watch amendments right now. First finish your income tax classes, which is applicable for November 22 examinations. Then come and watch this amendments video. That's it. You are absolutely ready for May 2023 as per May 2023 material. The changes are very, very, very minor. Getting it? So I hope I have given you a proper clarification. Now immediately you might have another doubt. So what about GST? For GST, institute just hold it, like institute just stick to the old material, October 2021 edition, based on which our Sreshta material is also available. Getting it? The institute has recently given supplementary material for May 23, November 23. On that supplementary material, we are going to conduct once again the class on that, and that video will also be uploaded on YouTube very soon. So GST supplementary material, whatever amendments material were there, for that also you will be getting some 3 to 4 hours amendments videos at free on this YouTube channel. That's it. So why late? So first finish up with your existing income tax classes or income tax, whatever your solutions, all that, then come back to this amendments video with the new year. It's only a change of year. I'm telling you, it's only a change of year. There were only minor changes in the existing provisions, very minor changes. Only in capital gains, in every problem, because of cost inflation index number, the answer will change. That's the only only place where you will find little new. That's it. And that is also clarified with the video in the amendment. I mean, that is also covered in our amendments. So while it, continue watching. Have a nice time. Take care. Continue watching.
A very good evening, students. Welcome to the Stress Start Taxation classes. This session, we are going to discuss about the amendments applicable for May 2023 and November 2023 examinations. Right, sir? So first, we are going to discuss about the amendments from the income tax law. And after that, we will discuss about the amendments from GST subject. Clear, sir? So this material I have prepared by taking into ICAI latest income tax material. So for May 2023 examinations, ICAI has released new edition of income tax material. And my income tax material was prepared recently only, just 3 months back. That means in the month of June, July time period, I have prepared my income tax latest edition material by taking into the consideration of the Finance Act 2022 amendments, which are made effective up to 30th April 2022. Right, sir? Now, for May 2023 examinations, the amendments made effective up to 31st of October, because there must be 6 months time gap between the examination attempt and the latest amendments. So up to 31st October 2022, whatever the amendments made effective, all that amendments will be applicable for May 2023. In my material, I have already updated up to 30th April 2022. So I have taken the latest edition of ICA material and I have taken my latest income tax material. I've compared both and picked up the amendments made effective between 1st May 22 to 31st October 22, and all the amendments were incorporated in this material. Okay, ma. So from these chapters, we got amendments, sir. Introduction to income tax, a very few amendments, that is two changes in the rate of surcharges, not in the change of the slab rates. PGBP, one or two amendments. We have capital gains. You can see here, majority of the pages are from the capital gains. The total amendments 49 pages, out of which only the capital gains contain 25 pages. So that means, it doesn't mean that half of the amendments are from the chapter capital gains. Capital gains, there is one important amendment that is very obvious every year, that is changing the cost inflation index, CII factor. Now, because of the change in the CII factor, I need to work out each and every problem again, because all our problems are purely based upon CII. Whenever there is involvement of the long-term capital gains calculation, then we need to use the CII, cost inflation index factor. Since the cost inflation factor has been changed, I need to change all my answers. So all the problems from capital gains and including the updated solutions I have provided in this material. So that is why the capital gains itself contain 25 pages. So that means out of the 49 pages of the amendments material, there are some blank pages I have given at the end of the every chapter for your notes. For your notes, and at the end of the every chapter, there is at least 1.5 to 2 pages blank space given for your notes. And you can take the printout of this material and you can work out the notes here itself. You can see here in the page number 4, first chapter amendments completed. Page number 5, I have given blank for your notes, for your references. You can write down the important points. So like that, the blank pages itself contains around 15 pages. So that means the rest of the amendments are hardly for 9 to 10 pages. Right, sir? Every one of you. So those who have already purchased my income tax material, who have already subscribed to my taxation classes, no need to worry, sir. You can happily listen to the classes. You can happily continue to that the material which you have already purchased, because there are no many amendments, no significant amendments. A very few amendments are there, right? So along with the existing material, you can just have this amendments material. That's it. Along with the existing recordings, just listen to this amendments classes recordings. More than enough for your May 2023 attempt, and as well as November 23 attempt. Of course, for November 23, it's too early to set, because whatever the addition of the material released by the ICI, that's only for May 23, not for November 23. So who knows, for November 23, maybe the new scheme of education comes into picture. So that's why there is no new edition of GST material. Instead of giving the new edition of GST material for May 23, ICI has released supplementary study material. Even that entire supplementary study material also, I'll give you amendments recordings. Are you following, sir? Every one of you. Right? Okay. Now let's move on. So the first amendment from the chapter Introduction to Income Tax. The very first amendment is, you can have a notes on it also. First chapter, Introduction to income tax. Introduction to income tax. The very first amendment you will be having is the change in the assessment year and the previous year. See, for May 2022 and November 2022, the relevant previous year is previous year 21-22. Corresponding assessment year is 2022-23. Now, for May 2023 and November 2023, for May 2023 and November 2023, now the previous years are previous year 2022-23, assessment year 2023-24. So this is the very first amendment. Change in the previous year and assessment year. Okay, mom. Every one of you. So in my existing material, you can find the previous year 21-22 and assessment year 22-23. Now that has to be changed, Amma, right? That's the major change I can say in the entire material, right? Only the change in the year, previous year 22-23, assessment year 23-24. This is first amendment. Okay, sir, every one of you. Now the second amendment. Tax rates for the assessment year 2022-23. There has been no change in the rates of income tax for all the categories of assessors in comparison to assessment year 22-23. No change in the slab rates, no change in the basic income tax rates. Okay, sir. There is only a change in the surcharge rates, and that is to first, in case of individuals HUF, AOP, BOI, AJP, right? Long-term capital gains under section 112A, short-term capital gains under section 111A, and dividend income. The maximum rate of surcharge applicable is 15 percentage. Are you following, sir? Every one of you, right? So I can say the second amendment is maximum rate of surcharge with respect to long-term capital gains under section 112A, short-term capital gains under section 111A, dividend income. With respect to these incomes, maximum surcharge rate applicable is at the rate of 15 percentage. The maximum rate of surcharge applicable is at the rate of 15 percentage. Okay, ma, that's the second amendment. Next, when it comes to an OP consisting of only companies as members, association of persons, third amendment. Third amendment. When it comes to association of persons, sir, when it comes to association of persons, anyone can become a member into AOP. An individual can become a member, an HUF can become a member, a partnership firm can become a member, LLP can become a member, a company can become a member. A combination of these persons can become the members of AOP, right, sir? Association of persons, whoever covered by the definition of the person given under section 2 clause 31, all of them can become the members of association of persons. Now, when it comes to, let us take an example. There is an AOP like ABC AOP. The AOP name is ABC Limited or ABC, I can say, where the members are A Limited, B Limited, and C Limited. So, three companies formed an association and became the members of that association. Right, sir? They formed an association for a common objective. Sometimes there are a project, there are projects which cannot be handled by a single company. If you remember, under section 35 AD, specified businesses, we have seen some specified businesses like cross country pipeline network, right, sir? Which involves thousands of crores investments, which cannot be handled by a single company alone. That's why you can see there a consortium of companies can take up this project. Like that we have studied. Do you remember? Suppose that now these three companies formed an association and have taken up that project. Now there is an AOP called ABC AOP where all the members of that AOP are companies. Now in that case, the rate of surcharge. So this amendment is applicable only for such AOPs, only the companies are members. So an OOP consisting of only companies as members. Now the rates of surcharges, you can see, if the total income is greater than 50 lakhs but less than 1 crore, it is 10 percentage. If the total income greater than 1 crore, it is 15 percentage. You can take here less than or equal to. Even if the total income exactly 1 crore, the rate of surcharge is 10 percentage. See, immediately after looking into this, you'll get a doubt compulsorily like, sir, less than 1 crore is there and more than 1 crore is there. Sir, what if the rate of surcharge, if it is exactly equal to 1 crore? So that's why I'm giving you this less than or equal to symbol. You can see here with the total income is greater than 50 lakhs but less than or equal to 1 crore. So then the rate of surcharge is 10 percentage. 10 percentage. Okay, sir, every one of you, right? Next, when it comes to, if the turnover exceeding 1 crore, then it is 15 percentage, right? So in case of an AOP consisting only companies as members whose total income greater than 1 crore, the total income exceeding 1 crore, then the surcharge payable at the rate of 15 percentage. Clear, sir, every one of you? The rate of surcharge. If you remember, sir, this is our existing material, right? The main material, not the amendments one, main material, right? Which I have given for, May 22 and November 22 attempt, right? So where the previous year 21-22, assessment year 22-23. Now this has been changed to previous year 22-23, assessment year 23-24. This is the first amendment. Second amendment is regarding the rates of surcharges. Yeah, here it is. Now you can see the existing provision in the case of individuals HU of AOP, right, sir? The applicable rate of surcharge is, you can see even for the AOP, there is the highest rate of surcharge 37 percentage. Are you following, sir? Every one of you, right? But now the highest rate of surcharge, the maximum rate of surcharge payable is 15 percentage only. And for your kind information, this amendment is applicable only when an AOP consisting only the members as companies. Consisting only companies as their members. Clear, sir? Every one of you. Okay. Next, cooperative society. The fourth amendment is cooperative society. Right? Now, when it comes to cooperative societies, right? In the case of a cooperative society, other than a cooperative society opting for section 115 BAD. What is 115 BAD? 115 BAA, BAB, BAC, BAD. These sections are concessional tax rate system sections. Concessional tax rates. Right, sir? So if the cooperative society opted to pay the taxes as per the regular provisions, then the rate of surcharges are if total income exceeding 1 crore but not exceeding 10 crores, the rate of surcharge is 7%. If the total income is exceeding 10 crores, the rate of surcharge is 12%. The rate of surcharge is 12%. Are you following, sir? Every one of you. The cooperative society opting to pay the taxes under regular scheme. Fourth one, cooperative societies opting to pay the taxes as per the regular taxation system. Okay, sir. If the total income is if the total income is greater than 1 crore but less than or equal to 10 crores, then the rate of surcharge is equal to 7%. If the total income exceeding 10 crores, then the rate of surcharge is at the rate of 12%. Sir, what are the existing provisions with respect to this? You can see for cooperative societies, yeah, here you can see the cooperative societies, the rate of surcharge fixed at 12%, only one slab rate. If the total income exceeding 1 crore, the rate of surcharge 12%. Even if it is exceeding 10 crores, the rate of surcharge 12%. But now, as per the latest amendment, the rate of surcharge is the slabs have been changed. If it is between 1 crore to 10 crore, then it is 7%. If exceeding 10 crores, it is 12%. So what has been changed, Amma? This has been changed. Instead of 12%, now this is given 7%. If the total income is between these slab, 7%. If exceeding 10 crores, 12%. If exceeding 10 crores, 12%. So hope you understand the amendment with respect to cooperative societies. Clear? Every one of you. Next. In the case of a cooperative society opting for 115 BAD. So when a cooperative society opting for 115 BAD, that means concessional tax rate system. The maximum rate of surcharge is 10%. This is the old provision only, sir. You can see in the existing material also. In the case of cooperative societies, in the case of cooperative societies, right? If they opted to pay the tax as per the provisions of 115 BAD, one is missing, 115 BAD, then the maximum rate of surcharge is 10%. That's the old provision only, not a new provision. What has been changed, Amma? This one, this 7%. Clear? Next. Yeah, when it comes to domestic companies, right? The basic income tax rates, the basic income tax, this is not surcharge rate, Amma. This is income tax rate, rate of income tax, right? If the total turnover or gross receipts in the previous year 2021 not exceeding 400 crores, the rate of income tax is 25%. In any other case, the rate of income tax is 30%. Then immediately you will get a doubt here. Sir, what is changed here? The year is changed here. Earlier, it is 2019-20. Now it has been changed to 2021. That's it. I'll show you in the material also. Yeah. Here it is, the rates of taxation. And when it comes to domestic companies, where the total turnover gross is in the previous year 1920 does not exceed 400 crores. Now, in the place of 1920, what you have to write about 2021. That's the amendment. That's the amendment. So that means whatever the tax rate applicable, what is the tax rate applicable for previous year 20 to 23 is purely depends upon the turnover of such company of the previous year 2021. So I'll explain you with the help of the notes, Amma. Don't worry. Now, amendment number 5. There is a company, let us say Infosys Company Limited is there. Infosys Company Limited is there. Now, the relevant previous year is previous year 2020 to 23. Now, the rate of tax of this previous year is purely depends upon the previous year 2020 21 turnover. If during the previous year 2020-21, the turnover is less than or equal to 400 crores, now the rate of tax is 25%. If turnover exceeding 400 crores, the rate of tax you need to apply is 30%. Clear, Amma? Every one of you? Okay. Next. Note. In the case of a domestic manufacturing companies, which are set up and registered on or after 1st April 2000, sorry, 1st October 2019 and commences manufacturing of article or things before 31st of March 2014, and those who are exercising the option under section 115 BAB. What is 115 BAB? Concessional tax rate system. Concessional tax rate system. The rate of income tax is 15%. The rate of income tax is 15%. Right? 15% of income derived from or incidental to manufacturing. Right, sir? Every one of you. Okay, sir. Next. This provision, anyhow, I have given, sir, in the material. In my existing material, this provision has already been incorporated. Okay, ma. Now, what is the change? And this year, from 31st March 2023 to it was increased to 31st March 2024. You can see here, this is amendment. Earlier, the time limit is the manufacturing, the setup and registered on or after 1st October 2019. And the deadline is 31st March 2023. Now the deadline increased to 31st March 2024. That's the amendment. Every one of you. Clear, sir? Now, that's it. So these are the amendments from the first chapter, Amma. What are the amendments we got? And one, when it comes to the maximum rate of surcharge limit is 15%, and this is applicable on all types of long-term capital gains. Applicable on all types of long-term capital gains, which means which including 112 long-term capital gains also. 112, 112A, 112 and 112A. Earlier, the maximum rate of surcharge limit applicable only for 112A. Now, the maximum rate of surcharge applicable even for 112 also. So that means here in the first amendment, yeah, I should also add the long-term capital gains under section 112. So this is latest amendment. The first amendment is every one of you. Clear? Next, the second amendment we have learned is regarding AOP surcharge rates. When in the AOP, only the companies registered as members, then we got an amendment. If such AOP's total income exceeding 50 lakhs, but not exceeding 1 crore, the rate of surcharge 10%. If exceeding 10 crore, 1 crore, sorry, right, then it will be 15%. Third amendment we have learned, cooperative society, right? If it is opted for regular taxation provisions and the total income between 1 crore to 10 crores, the rate of surcharge 7%. If total income exceeding 10 crores, the rate of surcharge 12%. The next amendment we have learned is if the cooperative society opted for concessional tax rate system, the maximum rate of surcharge is 10%. Okay, ma'am. Next. And when it comes to the companies, the year has been changed from 2019 to 2020-21. There is no change in the turnover criteria. It remains to be 400 crores. Only the year has been changed. And next, when it comes to the domestic companies opted for concessional tax rate system, which are engaged in the manufacturing of any articles or things. So again, the year has been changed, the deadline changed from 31st March 2023 to 31st March 2024. Okay, ma? Right. In the next session, we will see the amendments from the chapter PGBP. Clear, sir? A very good evening, students. Welcome to the Straight Star Taxation classes. Now, we are in the discussion of the amendments applicable for May 23 and November 23 attempt. So in the first session, we have completed discussion regarding introduction to income tax. That is chapter number 1. Now let's move on to the discussion regarding the amendments from the chapter PGBP, profits and gains from business or profession. Okay, ma. Now the first amendment is from the section number 40. Right, sir? Now, what is section number 40A? Inadmissible deductions. Section 40 small a discussed about the expenses which are not eligible for deduction. Inadmissible deductions. And in that, clause 2 discuss with any income tax, dividend distribution tax, wealth tax paid, not allowed as deduction. Right, sir? If you see, this is our main material. Disallowances in the case of all the SSEs covered by section 40 small a, income tax DDT paid not deductible. Section 40A clause 2. Here, actually, sir, suppose that I am doing a business from which I got a profit of, let it be some 10 lakhs rupees, on which I have paid a tax of 2 lakhs. I've earned a profit of 10 lakhs, on which I have paid a tax of 2 lakhs. Now, my question is, sir, whatever the income tax I have paid, this 2 lakhs rupees, now can I claim this 2 lakhs as my expenditure? Can I claim this as a deduction? Answer is no, you cannot. Income tax is straight away is a inadmissible expenditure. Income tax is a personal tax. It's your personal expenditure. For personal expenses, you won't get any deduction. Yes or no? Right. Now, actually, there are some assessees who have taken this provision as it is, right, sir? And they are going with the words mentioned in the law. The word mentioned in the law is income tax. So basically, income tax means to be what, Amma? Generally, income tax means to be, right? I'll explain you, ma. Income tax means to be, first we should take the base income tax rate, base rate, right? Let us say SSE is a company, the base rate of income tax, let us say 30%, and add surcharge, right, at the rate of 12%, which comes out to be some 3.6% totally. 33.6%, for which we need to add health and education cess at the rate of 4%. And this health and education cess we need to apply on income tax and surcharge. Uh, just give me a second, sir. So it should be 33.6 into 4%. It is 1.34. So the total tax rate comes out to be 34.94 percentage. 34.94 percentage. Right, sir. Let us say the profit of the company 10 lakhs rupees. So what is the income tax, Amma? 10 lakhs into 30 percentage, which comes out to be 3 lakhs. This is your income tax, for which we need to add the surcharge 3 lakhs into 12 percentage, which comes out to be 36,000. So 3 lakh 36,000 will be your income tax plus surcharge. Income tax plus surcharge, on which we have to apply the health and education cess at the rate of 4 percentage. 3 lakh 36,000 into 4 percentage, 13,440. So the total tax liability of the assessee 3 lakh 49,940. Sorry, 440. So now what the assessee's intention is, assessee's point of view is, sir, as per section 40 small a, only income tax is disallowed. As per the 40 small a clause 2, only income tax is disallowed. Now let me claim my surcharge and health and education cess as deduction, since the same were not covered by 40A2. What the words you have used in 40A2? Only income tax. Now let me claim surcharge and health and education cess as expenditure, as a deduction. So that's why an explanation has been provided to this section. So tax here including surcharge and cess as well. Surcharge and cess as well. So that means not only income tax, even the surcharge and health and education cess also not eligible for deduction. Are you following or not, everyone? So that means whatever the total tax you are paying here, the entire tax amount is now covered by 40A2, which is disallowed. Which is disallowed. So this is a first amendment from PGBP. Clear, sir? An explanation, a clarification has been given. That's it. So you can check out here. It is clarified. A clarification is given. The term tax shall be deemed to have always included any surcharge or cess on such tax. Hence, tax including surcharge and cess would be disallowed while computing the business income. Clear, sir, everyone? So whatever the profit you are getting, on that profit, whatever the total tax you are paying, total tax, which including income tax, surcharge, cess, the total tax is not eligible for deduction. This is amendment number 1. Number 2, certain deductions to be made only on actual payment basis. The second amendment is came from section 43B. What is 43B, Amma? Deduction based on actual payment. Deduction based on actual payment. 43B. In our main material, come to 43B, Amma. Yes, here it is. Deduction based on actual payment. So we have given a list of expenses where the deduction is allowed only on actual payment, irrespective of the method of accounting being followed by the assessee, whether he's following the accrual base of accounting, whether he's following the receipt basis of accounting, irrespective of the method of income being followed, right, sir? The method of accounting being followed. The list of expenses covered by 43B, the deduction is allowed only on actual payment, right, sir? Now, in this, the amendment is with respect to this point. Any interest on any loan or borrowings from any public financial institution, state financial corporation, state industrial investment corporation, or any scheduled bank. So whenever you are borrowing a loan from a public financial institution, suppose that I borrowed a loan from HDFC Bank. Now, on such loan, whatever the interest is going arising, that interest is allowed to me as a business expenditure only when I have actually paid it. Interest payable, not allowed as deduction. Interest paid, only eligible for deduction. Right, sir. Sir, actually what happened is I have taken a loan and since last 2 years I have not paid any interest. Now, what the banker has done is the banker converted the interest into principal. Sir, conversion of interest into principal, whether this is allowed as deduction? Answer is no. We have already discussed this point in the notes. Yeah. Where the interest on the loan is converted into a loan, the interest so converted will not be treated as having been actually paid and accordingly will not be allowed as deduction. Now, in this, some more instruments have been added, some more payment methods have been added, and they are, look at here, conversion of interest into a loan or a borrowing or a debenture or any other instruments. Explanation 3C, 3CA, and 3D clarifies that if any sum payable by the assessee as interest on any such loan or borrowing or advance is converted into a loan, borrowing, or advance, or so the words which I have highlighted is the amendment from this section number. Debenture or any other instrument by which the liability to pay is deferred to a future date. So I'm not paying the interest immediately. I'm converting this unpaid interest as debentures. I said to the banker, so whatever the interest I'm going to pay you, like I'm liable to pay you 10 lakhs na. Okay, do one thing. I'll issue 10 lakhs worth of debentures to you, right? And I'll redeem these debentures after 5 years. So that means what my unpaid interest is converting into debentures and the debentures are going to repay after 5 years. So are you paying interest immediately? No. Just conversion of the unpaid interest into debentures doesn't mean you actually paid the interest to banker. Hence the deduction not allowed. Clear? So the interest so converted, not actually paid, shall not be deemed to as actual payment. Hence would not be allowed as deduction. So the clarification explanations only reiterate the rationale provision that the conversion of interest into a loan, borrowing, advance, or debenture, any other instruments, where the liability to pay is deferred to a future date, does not amount to actual payment. It does not amount to actual payment. Hence, since you not actually paid, that amount not allowed as deduction to you. As simple as that. Okay, ma. That's the amendment from section 43B. The second amendment from this chapter. Now, the third amendment, expenditure prohibited under any law. Section 37, if you remember, section 37 we have discussed as a residuary section where it allows the deduction with respect to the expenses which are not covered by the section number 30 to 36. Section 30 to 36 are specific expenses covered like section 30 expenditure relating to the buildings, right sir? Section 31 expenditure relating to plant and machinery, furnitures and fittings. 30 31 32 depreciation. So like that, each and every section is specific to a particular expenditure. Whereas section 37 is a residuary section which covers all those expenses which are not covered by 30 to 36. But of course, there are certain conditions to be satisfied in order to claim the deduction under section 37. right? That expenditure should have been incurred during the current previous year. That should be incurred wholly and exclusively for the purpose of business or profession. That should not be a personal expenditure. That should not be a capital expenditure, right? And that should not be prohibited under any law. That should not be in the nature of offense, or that should not be in the nature of prohibited under any law. Then only you are eligible to claim a deduction, sir. Yes or no? Right? Do you remember? Come to section 37 in our main material. Yeah, here it is, section 37 in our main material, residuary section, right? So you can see the conditions. There should be an expenditure. It should not be covered by 30 to 36. Should not be in the nature of capital expenditure. Should not be in the nature of personal expenditure. Should have been incurred during the previous year. It should be incurred in relation to the business carried on by the assessee. It should be exclusively and wholly incurred for the purpose of such business. And this is our latest amendment. It should not have been incurred for any purpose that is an offense or is prohibited by any law. So again, there are certain people have taken the true meaning of this provision and they have come up with their own understandings. They said, sir, you said like here that expenditure should not be incurred for any purpose that is an offense or prohibited by any law. Sir, any law means the law prevailing in India, or this rule is also applicable for any law prevailing outside the India. The provision is not clear. There is an ambiguity. Yes or no? Sir, if you said that should not be prohibited by any law which is implementing in India, so that means if that expenditure is prohibited by a foreign law, now can I claim it as a deduction? No, no, you cannot claim. Where it was mentioned? It was mentioned only prohibited by any law. It was not mentioned by Indian law or by foreign law. So that's why again there is a clarification has been added to this provision. And the clarification said prohibited by any law inside the India or outside the India. Right, sir? Inside the India or outside the India. Okay, now that's the clarification added to this particular provision. Clear. And there's one more amendment from this, like, yeah, regarding this particular point. The claim of any expenses incurred for providing freebies to medical practitioner is in the violation of the provisions of Indian Medical Council rule regulations, and it's clarified that the expenditure so incurred shall be inadmissible. But actually, under in the recent times, under certain judicial decisions, if any pharma company providing gifts or benefits to their medical practitioners, that is eligible for deduction. Right, sir? You can see here the first amendment, you can see where expenditure incurred in respect of any offence which is prohibited by under any law is not allowable. However, under certain judicial decisions, expenditure of compounding nature, benefits provided by pharma companies to its doctors by way of travel, hospitality, gifts, and conference held to be allowable. So, the expenditure of compounding nature, right? And the benefits provided by pharma companies. This is important. Benefits provided by pharma companies to doctor by way of traveling, right, sir? So that means that pharma company provided free flight tickets to their doctors on their vacation. Hospitality, gifts, conference fees. These are allowed as deduction now. Earlier it was not allowed, but during the recent judicial decisions, these were made allowable as a deduction. So it's proposed that the following expenditure will not be allowed on the ground that it constitutes offense or prohibition under any law. So here the list is mentioned, number 1, number 2, and number 3. So what are they? Expenditure incurred for an offense under which are prohibited by any law in or outside the India. In or outside the India. Okay. Next, any benefit or perquisite provided to a person and acceptance of such benefit or perquisite by such person which is in the violation of any law. Not allowed. Compounding fees outside the India. In or outside the India, not allowed. Okay, ma. So this amendment will take effective from 1st April 2022. Clear, sir, every one of you? Right? Okay. Next. So these are the amendments from the PGBP chapter. 3 amendments. First one, 40 small a, right? Just a clarification is given. Tax including surcharge and cess. Second one, deduction on actual payment, right? So if any unpaid interest converted into debenture or any other instrument where the liability to pay arise at a future date, so that unpaid interest so converted into debenture not amounts to actually paid, hence not eligible for deduction. Third amendment, expenditure prohibited by under any law inside the India or outside the India. Even if the expenditure is prohibited by a foreign law and you have incurred that expenditure, you are not eligible to claim that expenditure. That expenditure not eligible for deduction. And second amendment, benefits provided by the pharma company to its doctors by way of traveling, hospitality, gifts, conference fees, eligible for deduction. That's it. Clear, sir? Right. In the next session, we'll discuss the capital gains amendments. Okay, ma? Bye. A very good evening, students. Welcome to the Straight Start Taxation classes. So in the last session, we have completed discussion regarding amendments applicable for May and November 23 exams from the chapter PGBP. Now it's time for the amendments applicable for May 23 and November 23 exams from the chapter income from other sources. Okay, sir. The first amendment, of course, there are two amendments from this chapter and the two amendments are from the section 56, subsection 2, clause 10, gifts. What we have discussed in this particular section, Amma, we have discussed taxability of gifts. Taxability of gifts. Right, sir. So the first amendment from the topic immovable property. So whenever you're receiving the immovable property as a gift, what are the provisions, ma'am? If you are receiving that immovable property as a gift for without any consideration, then the stamp duty value of such property would be taxed as income of the recipient if exceeding 50,000 rupees. The stamp duty value of such immovable property received as gift. Suppose that if I have received a land as a gift, the land value 10 lakhs rupees, and the 10 lakhs worth of land I have received as a gift without any consideration. I have paid nothing for such land. So then the entire 10 lakhs is taxable as a gift in my hands without any consideration. I am paying nothing for such gift only. The second case for inadequate consideration. Sir, I am receiving that land as a gift, but not for free of cost. I am paying something. I am paying something. How much you are paying? Sir, the stamp duty value of the land is 10 lakhs rupees, but I am paying a consideration of 2 lakhs. So what is the difference? The difference amount is 8 lakhs. Now this difference amount shall exceed, point number A, 50,000 rupees, and point number B, 10% of consideration. What is the consideration amount? 10 lakhs into 10 percentage. Just give me a second, sir. 10% of the consideration paid. So consideration paid in the 2 lakhs into 10 percentage. 20,000 rupees. Now, among these two, whichever is higher, you have to take the higher amount comes out to be 50,000 rupees. So the difference amount is 8 lakhs. The higher of these two is 50,000. So the difference amount exceeding the higher amount. So the entire amount of the difference is taxable. So whenever you're receiving the immovable property for inadequate consideration, this is a provision. You have to take the stamp duty value of the immovable property, right? So 10 lakhs rupees is the actual stamp duty value. So 10 lakhs worth of land you have received as gift, and in return you paid only 2 lakhs. So you have received it for it with inadequate consideration. Now the difference amount is taxable. However, the difference amount should exceed the higher of the 50,000 or 10% of consideration. Here in our example, it is exceeded, hence the entire amount of the difference is taxable. Now in this provision, there is a latest amendment, and the latest amendment applicable only with respect to the immovable property being a residential unit fulfilling the stipulated conditions. We have some conditions in it. So whenever you're receiving a residential unit as a gift, and that is to inadequate consideration. Now in that case, this 10 percentage is increased to 20 percentage. Increase it to 20 percentage. Higher threshold limit 20 percentage of such consideration, or 50,000, whichever is higher. So this amendment exclusively applicable only for the residential units fulfilling the stipulated conditions. Sir, what are the conditions? I'll tell you, Amma. Look at here. In the case of immovable property, being a residential unit fulfilling the stipulated conditions mentioned below, the conditions are mentioned, Amma. Here you can see the following conditions. It must be a residential unit which is transferred during the period between 12th of November 2020 and 30th June 2021. Such transfer is by way of first time allotment of the residential unit. That must be a first time transfer, and the consideration paid is payable as a result of such transfer is less than or equal to 2 crores. So the consideration amount shall not exceed 2 crores. And if these conditions are satisfied, then if such property is received for inadequate consideration, then and you're receiving from a person who is maintaining that immovable property as a stock in trade. Suppose that my friend is there, ma. My friend is a real estate agent. My friend is a real estate agent. So buying and selling of immovable properties is his business activity. Okay. So for seller, it must be a stock in trade. For buyer, I am the buyer. For me, it is a capital asset. For me, it is a capital asset. Okay, ma. Right? So for seller, it must be a stock in trade. So from a person who holds such property as a stock in trade, then only if the stamp duty value of the residential unit exceeding the sales consideration by the 20% of consideration or 50,000, whichever is higher. Right, sir? So I'll tell you an example for this, for your easy understanding. So the first amendment from the section 56, subsection 2, clause 10. So suppose that Mr. X is there, seller, who is a real estate, who is doing the business of real estate. who is doing the business of real estate. Okay, ma. Now, as a part of his business, he sold one of the residential unit to his friend. The very close friend of him is Mr. Y. Mr. Y is a buyer, right? So he is into the textile business. For X, whatever the house property is transferring to Mr. Y, for X it is a stock in trade because X is engaged in the business of real estate. So buying and selling of the immovable properties is a business activity. For Mr. Y, it is a capital asset because Y's business is a textile business. So for him, the immovable properties are capital assets. Okay. The stamp duty value of the property so transferred, let us say 25 lakhs rupees. 25 lakhs rupees. Consideration paid, let us say some 15 lakhs rupees. Now you can see the difference amount is 10 lakhs. Now you may ask me, sir, whether this entire difference is taxable in the hands of Mr. Y as gift under the head income from other sources. That depends upon, look at the higher amount of these two, 50,000, and second one is 20% of consideration paid. So that is, what is the consideration paid, Amma? 15 lakhs into 20 percentage, which means to be 3 lakhs. So whichever is higher, take the higher amount, that is 3 lakhs rupees. What is the difference amount? 10 lakhs. What is the higher amount here amount? 3 lakhs. So the difference amount exceeding the higher of 50,000 or 20% of consideration. Since the difference amount exceeding the higher amount, the entire amount of the difference. Now the entire amount of the difference, taxable as gift in the hands of Mr. Y. So earlier we used to take the 10% of consideration, but now for immovable properties being a residential unit, which is transferred between the stipulated dates. What are the dates, Amma? It should be transferred between 12th of November 2020 till 30th June 2021. It must be the first time allotment, and the condition is the last one, the consideration amount not exceeding 2 crores rupees. If all these conditions are satisfied, you have to take the higher threshold of 20%. Clear, sir? So though the residential unit, there should be the stock in trade for the seller, the applicability of the higher threshold limit of 20%, it should be a capital asset in the hands of the buyer. So for the buyer, it must be capital asset. Okay, ma. So this is the first amendment from this section. Now the second amendment. Sir, we have seen some exceptions to section 56(2) clause 10. There are a list of exceptions, around 10, 11 exceptions. Gift received from relative, not taxable. Yes or no? Gift received on the occasion of marriage, not taxable. Gift received by way of inheritance, not taxable. Gift received, right, on the occasion of the death of the giver, the payer, right, not taxable. Like that, we have seen some exceptions where you can see here, yeah, exceptions. Gifts received from the following persons or situations not taxable. Gift from a relative not taxable. On the occasion of marriage not taxable. By way of will or inheritance not taxable. In contemplation of the death of the payer not taxable. From any local authority not taxable. Like this, we have seen some list on it. Now for that list, two more exceptions were added. Two more exceptions were added. That's the amendment. Two more exceptions were added. What are the exceptions, ma'am? Non-applicability of section 56 to clause 10. So the first exception, gift received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness related to COVID-19. Related to COVID-19. Subject to such conditions notified by the central government. Right, sir. Suppose that I'll explain you with the help of example. The second amendment from the chapter. Right, sir. There are two friends, Mr. X, Mr. Y. Assuming that Mr. Y got affected by COVID, COVID-19 disease. Now he's in very bad financial condition. He spent almost whatever the money he saved during his lifetime. Still, Mr. Y needed money for the medical treatment of COVID-19. Now, in this situation, Mr. X being the best friend of Mr. Y, Mr. X gifted him 10 lakhs rupees. Now, this 10 lakhs is for the purpose of medical treatment for COVID-19. Mr. Y received the 10 lakhs rupees from X, and Mr. Y spent the entire amount of the 10 lakhs for the medical treatment of COVID-19. Now, this 10 lakhs is now not taxable as a gift. Not taxable as a gift. So, any person receiving any amount from any other person for the purpose of the medical treatment of COVID-19, either for himself or for any of his family members, then whatever the amount he received, that amount shall not be treated as a gift only. Right? The conditions are that amount must be spent for the medical treatment of COVID-19, right? And you can add more conditions. The conditions have not been specified, but in the general sense, you can take the conditions as the amount must be incurred for the treatment related to COVID-19. That the doctor must have prescribed the medicines. The doctor must have prescribed and the must have certified, right? Okay, this much of expenditure incurred by the assessee for the medical treatment of COVID-19. So these conditions, in a general sense, we can assume on it, right? So that's why they have given the wording subject to conditions notified by the central government. Generally, the central government notified these conditions only. Assessee must have incurred the entire amount for the medical treatment of COVID-19. A certificate must be obtained from the hospital from where he taken the treatment. All the medical bills must have been attached for claiming this. Yes or no? Right, sir. So if any individual receiving any amount from any person in respect of expenditure incurred by him on his medical treatment or the treatment of any member of his family, and that must be incurred in relation to the COVID-19 treatment, then only you will get the this exception benefit only. Okay, next. Sir, in case if I am receiving that amount from my employer, suppose that in this example, Mr. X happened to be the employer of Mr. Y. So Y is the employee, X is the employer. So employer given 10 lakhs rupees to Mr. Y for the medical treatment of COVID-19. Again, the same provisions continues and same provisions continues. Are you following now? Right? Next, sir, in case, suppose that in this case, Mr. Y got affected with COVID-19 and assuming that Mr. Y died. Mr. Y died. Now the employer paying an amount of rupees 20 lakhs to the deceased employee family members. As a matter of gratitude, Mr. Y worked in our organization for 20 years, is a very genuine and dedicated worker. So we lost a great person. So as a matter of gratitude, I'm giving you this 20 lakhs rupees. So the family lost the income earning person. Now the family is in trouble. So it's the responsibility of the employer to show some gratitude. So the employer given 20 lakhs rupees to the deceased employee family members. Now this entire 20 lakhs is not taxable in the hands of family members. In the hands of family members. Right, sir? In case, sir, assuming that there is no employer and employee relationship between X and Y, they were just friends. Why affected with COVID-19? Why affected with COVID-19? Right? And why died due to COVID-19? Now, Mr. X, Mr. X, given 20 lakhs rupees, or I can say 10 lakhs rupees to the family members of Mr. Y. Now here, the amount is being received from any other person, not from an employer. If received from the employer, then it is fully exempted, not taxable. Not taxable, no limit at all. But if received from any other person, then there is a threshold limit of 10 lakhs. Up to 10 lakhs not taxable in the hands of family members only. In this case, it is not taxable. Not taxable. Suppose that Mr. X given 15 lakhs rupees to family members of Mr. Y. Now, in this case, the amount actually received 15 lakhs and you can claim exemption up to 10 lakhs. Now, the remaining 5 lakhs is taxable. Remaining 5 lakhs is taxable as gift. Taxable as gift in the hands of the family members of deceased employee. But this is applicable only for the deceased cases, death cases. Normal medical treatment of COVID-19, whatever the amount is exempted, not taxable at all. Not taxable at all. Are you following now? In case if that employee died, that person died due to COVID-19. Now the family members getting the money after the death of that person due to COVID-19. If the amount is received from employer, there is no limit at all. Whatever the amount received from employer, fully not taxable. If the amount is received from any other person other than employer, there is a limit of 10 lakhs. Up to 10 lakhs not taxable. If the gift amount exceeding 10 lakhs, only the excess portion is taxable. Clear, ma? Very, very important amendment. Ma, so far whatever the amendments we have discussed, either from introduction to income tax or from PGBP, not so important because they were just clarifications. They were just clarifications. But this is a very important amendment. This is a very important amendment. Okay. The first case is medical treatment of COVID-19 fully exempted, not taxable. Second case is the amount is being received by the member of the family of a deceased person. The person have been died due to COVID-19. Now the family members are receiving the amount. If the family members receiving from employer of the deceased person without any limit, fully exempted, not at all taxable. If received from any other person, then you have a limit of 10 lakhs. Up to 10 lakhs, it is not taxable at all. If exceeding 10 lakhs, the excess portion taxable. Okay, ma. Next, where the cause of death of such person illness must be related to COVID-19, and the payment is received within 12 months from the date of such death and subject to such other conditions notified by the central government. Are you following, sir? Every one of you. Okay. So these are the amendments from the chapter income from other sources. So how many amendments? Two amendments. First one is regarding immovable property. Higher threshold limit of 20% have been added, but that is applicable only for residential units. For seller, it must be stock in trade. For buyer, it must be capital asset. Consideration amount not exceeding 2 crores. Okay. And the second amendment is from the topic 56 to clause 10. Again, the same sections, but now two more exceptional cases added. First exception case is right medical treatment regarding COVID-19. Whatever the amount you have received for the medical treatment, fully exempted, not taxable. And the second case is on the occasion of the death of the person due to COVID-19. If any amount is received from the employer, fully exempted, no limit at all. If any amount received from any other person, there is a limit of 10 lakhs rupees. Clear, sir? Right. So next session. So we'll come up with amendments from chapter 6A deductions. Okay, ma. Till then, have a good day and good night, sir. A very good morning, students. Welcome to the Stress Taxation classes. In this session, we are going to discuss about the amendments applicable for May 23 and November 23 examinations from the chapter deductions from chapter 6A. Chapter 6A deductions. Right, sir. Now here in this chapter, we got two amendments. A very small amendments, not that significantly or not that so important amendments. The first one is section 80 CCD, contribution to NPS, right? So earlier, sir, we have studied the higher amount of the deduction, that is 14% of the salary. This deduction is restricted to only to the central government employees. Now the wordings have been changed. Now that higher deduction of 14% even applicable to state government employees as well. For employer contribution, if you remember, sir, for employer contribution, initially the employer contribution to the NPS should be treated as salary income, and thereafter while you are claiming deductions under chapter 6A, the employer contribution to NPS, you can claim deduction under section 80 CCD. So on first, you have to treat it as your income, and then you can claim it as deduction under chapter 6A. And what is the maximum deduction allowed, Amma? 14% of salary. This is employer contribution, right, sir? So earlier this higher threshold limit of 14% applicable only for central government employees. Now this benefit is made applicable even to the state government employees. That is the first amendment, right? So you can see incentive to NPS subscribers for the state government employees under section 80 CCD2, contribution made by the central government or state government. This is newly added, or any other employer in the previous year to the said account of the employee is allowed as deduction in computation of the total income. The entire employer's contribution would be included in the salary income of the employee. However, deduction under section 80 CCD2 would be restricted to 14% of salary in the case of contribution made by the central government or the state government, and to 10% of salary in case of the contribution made by any other employer. So now if employer happens to be central government or state government, the deduction allowed to the employee is 14% of salary. In case of any other employer, the deduction allowed is 10% of salary. 10% of salary. Clear, ma? Everyone? You can see the amendment provision I have mentioned here. For the words central government, wherever they occur, the words central government or the state government shall be substituted. And this amendment made with retrospective effective, made with retrospective effect from the back date. This amendment made effective from 1st of April 2020 onwards. 1st April 2020 onwards. Retrospective amendment. This is clear, sir? Right. So this is our main material for May 22 and November 22 attempt. The existing material here you can see section 80 CCD, right, sir? So quantum of deduction, the maximum amount of deduction if the contribution made by the central government employee for employer contribution 14% of salary. Other than central government employee for employer contribution 10% of the salary. Now what you have to do is, right, if the contribution is made by central government employee or state government employee, these wordings you need to add here. So now even the state government employee will get a deduction of 14% of salary. Clear, sir? Now other than central government and state government employee, other than central government and the state government employee, then 10% of salary is a deduction. Suppose that I'm working in a private organization. I'm working in a private organization. My employer is some XYZ Limited. So for me, the deduction allowed is 10% of salary only. For me, the deduction allowed is 10% of salary only. Are you following or not? If I'm a central government employee, 14% of salary. State government employee, 14% of salary. That's it. That's the amendment from the section number 80 CCD. Clear, ma? Now, come for the second amendment. Second amendment came from the section 80 DD. DD, do you remember? Disabled dependent. Medical treatment, medical expenditure incurred for a disabled dependent. In the case of the normal disability, flat 75,000 rupees allowed as deduction. In the case of severe disability, flat 1,25,000 rupees will be allowed as deduction. Yes, sir. Right? And and what are the amounts eligible for deduction? Any medical expenditure incurred towards the maintenance of the disabled dependent, or any contribution or any amount paid or deposited under a scheme framed in this behalf by the LIC or any other insurer, even that amount is also eligible for deduction. Yes or no? See, as long as you are alive, you can take care of your disabled dependent. Suppose that if X dies before the disabled dependent, right? So then who will take care of the disabled dependent? That is why Mr. X making contributions, X making the amounts or deposits under the scheme framed in this behalf by the LIC or any other insurer. Now, whatever the amount he paid, that amount is also eligible for deduction. Sir, what about the taxability of the amount received from that scheme? Do you remember if the disabled dependent predeceases the assessee? If the disabled dependent predeceases the assessee. Now, in that case, whatever the amount received by the assessee from that particular scheme, in the event of the death of the disabled dependent, then whatever the amount received by the assessee will be deemed as income in the hands of the assessee. Suppose that the disabled dependent dies in the year 2021-22. Now, from that scheme, Mr. X received an amount of 10 lakhs rupees. The assessee received 10 lakhs rupees. The entire amount of the 10 lakhs will be taxable in the hands of the assessee, because he is making the contributions for the purpose of maintenance of the disabled dependent. Now, the disabled dependent itself is no more. Yes or no? He died. So, the purpose for which the contributions are being made is no more required. Now he is receiving a lump sum amount from the scheme. That lump sum amount is taxable in the hands of Mr. X. Now, what is the amendment here? Sir, in case if the assessee dies before the disabled dependent, or in case the scheme has been matured, the assessee attains the age of 60 years or more, then now the amendment is the assessee either has to nominate the disabled dependent to receive the amount in the event of his death, or he has to nominate any of the family member to receive that amount. Now, whosoever receiving that amount, either the disabled dependent or any other nominated person from the family, that amount is not taxable in their hands. So far, we have learned that if the disabled dependent predeceases assessee, what are the tax provisions? Suppose that junior X is a disabled dependent, his son X is a assessee. Junior X dies before Mr. X. Now, Mr. X is receiving lump sum amount that is taxable in the hands of X. Now, think the otherwise. Mr. X dies before the junior X. The disabled dependent is good. He is alive, but the assessee unfortunately died. He met with an accident and died on the spot. Now, who is going to receive that amount? Either the disabled dependent or the nominee. So, whosoever receives that lump sum amount from the scheme, that will not be taxable in their hands. So, that's the amendment came into this particular section, sir. Okay, now, so you can see, so deduction in respect of the maintenance, including the medical treatment of a disabled dependent, section 80DD, right? So, this is the provision which is already there, and the newly added provisions are this, right? The scheme should provide for a payment of the annuity or a lump sum amount for the benefit of a dependent being a person with a disability. So the scheme in which you are making contributions, that scheme should provide the annuity amounts, means per annum some lump sum amounts, per annum 1 lakh rupee, per annum 2 lakh rupee should be paid to the person with disabled dependent, being a disabled dependent, or a lump sum amount in the event of the death of the individual or the member of the HUF in whose name the subscription was made, or on attaining the age of 60 years or more by such individuals or the member of HUF, and the payment or the deposit to such scheme has been discontinued. See, as long as he was in earning, suppose that he's a salaried employee, so till the age of retirement, he will get a monthly income in the name of salary and he will make contribution to the scheme. But after he got retired from the services, although he got pension, he will get pension, but not equal to salary now. So that's why he discontinued the scheme. Then the assessee must nominate either the dependent or being a person with disability or any other person or a trust to receive the payment on his behalf for the benefit of dependent being a person with disability. So either in the event of the death of the individual or that individual after attaining the age of 60 years, then that individual has to nominate either the person with disability or any other person to receive the amount from the scheme. Now the provision. Come to the concept of deemed income. If the dependent being a person with disability predeceases the individual, this is the existing provision only, in whose name the subscription was made, the amount paid or deposited under the scheme would be chargeable to tax in the hands of the assessee. This is the old provision only. Now look at the new provision. However, such deeming provisions would not apply to the amount received by the dependent being a person with disability before his death by way of annuity or lump sum under the scheme mentioned in 2 of B point above, where the individual or HUF attains the age of 60 years or more and the payment or deposit to such scheme has been discontinued. So if the amounts are received by person with disability, if the amounts are received by the any other nominated person, the deeming income provision is not applicable to them. Clear? However, conditions are there. In order to claim this deduction, a certificate from the medical authority should be provided along with the return of income. So while that person with a disability filing his return of income, he has to furnish a certificate which is issued by the medical authority. And the disability requires a reassessment, a fresh certificate from the medical authority shall have to be obtained after the expiry of the period mentioned in the original certificate in order to continue the claim the deduction. Hope you understand, Amma. Okay, what is the existing provision? If the disabled dependent predeceases the assessee, the disabled dependent dies before the assessee. Now the assessee receiving the amount, lump sum amount from the scheme, say 10 lakhs rupees, the entire 10 lakhs is taxable in the hands of assessee. That's the old provision. Of course, it is still in continuation. It is still in continuation. It is existing provision still in continuation. What the new provision is added, in case if the assessee dies before the disabled dependent, or in case if the assessee attains the age of 60 years and he given the instructions to the scheme that LIC, okay, from now onwards, pay a annuity to my disabled dependent or pay a lump sum amount to my disabled dependent. Now, accordingly, that LIC paid a lump sum amount to the disabled dependent. Now, whatever the lump sum amount received either by the disabled dependent or any other nominated person, that amount is not taxable in their hands. This is a new provision. Clear, sir? Every one of you? Right. So these are the two amendments from the chapter 6A deductions. Okay. Right. Next session will come up with the amendments from the chapter return of income. Children, bye, sir. A very good evening, students. Welcome to the straight start taxation classes. In the last session, we have completed discussion regarding the amendments applicable for the May 2023, November 2023 from the chapter 6A deductions. Now time for the amendments applicable for May 23 and November 23 examinations from the chapter return of income. So we have only one amendment from this chapter and the most important amendment. You can definitely expect a question or an MCQ from this amendment for May 2023 examinations and November 2023 examinations. One of the most important amendments. Compulsorily, you can expect a 4 marks question from this amendment. You can note down, right? These wordings for May 2023, definitely you will get a question from this amendment. Only one amendment from this chapter, and that is the most important amendment. Because a new section has been introduced, section number 139 8A, and a new concept, a new return has been introduced, that is the concept of updated return. So far we learned about regular returns under section 139.1, belated return under section 139.4, revised return under section 139.5, defective returns under section 139.9. Now a new concept has been added, that is called updated return. So that's why it's the most important amendment. Everyone should be very, very careful. Now, let us try to understand what is the concept of updated return. Now, amendments from the chapter return of income. Amendments from the chapter return of income. And we got a new concept of updated return. Under section 139 8A. Now, what is this concept of updated return? A very simple concept, sir. Very simple concept. Generally, this concept has been introduced for the mutual benefit of the assessee and as well as department. And if you ask me particularly, I can say it's more beneficial to department than assessee. Right? Why? You will get to know within few minutes. Okay, sir. Sir, I am filing a regular return, right? Sir, am I required to file an updated return? Not required, right? If you want to revise it, you have a concept called a revised return. You can file the revised return. Sir, I have filed a lost return. Am I required to file an updated return? No. So then whom it is applicable? See, generally, whether you are filing the regular return or not, regular return under section 139(1), belated return under section 139(3), and revised return under section 139(4). Sorry, 139(4) and 5. So irrespective of the fact whether you are filing these returns or not, right? Whether or not, SSE have filed any of these returns, SSE can file an updated return. SSE can file an updated return. Sir, I have already filed a regular return under section 139(1) within the due date for the filing of return of income. Now, can I file an updated return? Yes, you can file. Sir, earlier I have filed belated return. Now, can I file an updated return for the same previous year? Yes, you can file. Sir, I have already filed the original return, but later on I found some mistakes. I revised it. So I filed a revised return under section 139(5). Now, can I file an updated return for the same previous year? Yes, you can file. So whether or not, whether you filed these returns or not, right? Whether you filed them or not, you are eligible to file an updated return, right, sir? And here, is there any time limit for the filing of the updated return? Yes. The time limit for the filing of the updated return is time limit for the filing of the updated return is the updated return should be filed updated return should be filed within 24 months from the end of the relevant assessment year. From the end of the relevant assessment year. Now, what is the relevant previous year for our examination attempt, Amma? Previous year 22-23. Relevant previous year 2022-23. Means what is the relevant assessment year, Amma? Relevant assessment year 2023-24. Relevant assessment year 2023-24. Now, with respect to relevant assessment year 2023-24, you can file updated return. An SSE can file an SSE can file an updated return on or before 31st March 2026. on or before 31st March 2026. You can calculate from the end of the relevant assessment year, you have a time limit of 24 months. You have a time limit of 24 months. So from 31st March 2024 till 31st March 2026, you have a time limit of 24 months. So with respect to the assessment year 23-24, you can file an updated return on or before 31st March 2026. Sir, I have a doubt. So what is the purpose of filing an updated return? Sir, I have filed the original return within the time limit, and I have made some omissions. So now I would like to file an updated return. Not required, na? See, for correcting the omissions, you have a concept called revised return. So why can't you file a revised return instead of updated return? Yes, sir. We can file revised return. Then why the concept of updated return has been introduced? The reason being, sir, what is the time limit for the filing of a revised return? 24 months. No, no. So you can file the revised return only up to 31st December of the relevant assessment year. Yes or no? Right. Every one of you. So for revised return, you have to file that within 31st of December of the assessment year itself. Right, sir? Before 3 months from the end of the assessment year. You can see the concept of revised return in our main material. It should be filed at any time before the 3 months prior to the end of the relevant assessment year. So for the assessment year 22-23, right, we can file a revised return up to 31st of December 2022. So in our example, right, sir, this is a, let us assume that this is our previous year 2020-23, and now you are going to file the original return. Suppose that assessee is Mr. X, an individual. So as per the, this is our assessment year 2023-24. As per the provisions of section 139(1), he has to file the return of income on or before 31st of July 2023. This is the time limit for the filing of regular return under section 139(1). If he misses the due date, maximum he can file the belated return, or if he filed the original return but he found some mistakes, he can file a revised return latest by 31st March December 2023. Either he can file a belated return or he can file a revised return maximum by 31st of December 2023. Sir, what if the case if we find that omission, if we find a mistake after 31st December 2023, the return cannot be revised. You cannot file a belated return after 31st of December. Then if you want to file a return, if you want to make a correction in your original return, how can you do? That is why the concept of updated return has been introduced. So this is the end of the assessment year, 31st March 2024. From here, you have a time limit of 24 months, that is 31st March 2026. Now, in this time period of 24 months, you can file an updated return. You can file an updated return. Are you following now? So that is the main purpose of introducing concept called updated return. Sir, if I miss a due date, I have a concept of belated return. Very good. If I find any mistakes, if I omitted any income details or tax payment details or annexures, notes to accounts, financial statements, then I have a concept called revised return. Very good. Defective return concept is also there already. Then what is the purpose of updated return? The purpose is that there is a time limit and that is very shorter. Earlier it used to be 24 months, and even for the filing of belated return, revised return, the department used to give you 2 years time period. But the 2 years time period reduce it to 1 year, and that 1 year now been reduced to up to 31st of December. So for individual cases, 31st July is any of the normal due date. From there onwards, August, September, October, November, December, 5 months time limit is given for the individual persons to file a belated return or a revised return. The maximum time limit is having only 5 months. For companies, for your kind information, the normal due date itself is the 31st of October. If a company wants to file a belated return, if a company wants to file a revised return, the maximum time limit it's having in his hands is only 2 months, November and December. So that's why the concept of updated return introduced and given 24 months time period. Okay, SSC, take your own time and file an updated return. Then immediately you will get some doubts. Sir, if that be the case, if 24 months time limit is given for updating the return, then no one will go for the belated return and no one will go for the revised return. Everyone will opt for the filing of the updated return and enjoy the 24 months time period. Instead of paying the tax immediately by filing a belated return, instead of paying the tax by immediately by filing a revised return, they will opt for the updated return. They will take the time limit of 24 months and they will file in the 24th month. Right? Or if they forgot to claim any refund and they got to know about this after some 20 months, so they happily filed an updated return and claim the refund. That is why, if you remember my words, at the beginning of this topic, I have told that this is mutually beneficial to both SSC and department, but more beneficial to department. Why? So whenever you happen to file an updated return, right? By filing an updated return, you cannot reduce your tax liability. You cannot reduce your tax liability and you cannot claim a refund. You cannot claim a refund. You cannot reduce your tax liability and you cannot claim a refund. If at the time of filing of the updated return, if the tax liability is happen to be reduced, then you cannot file the updated return. The software won't accept. The software will accept the filing of updated return only when there is an increase in the tax liability. So the department, that is why the department has given you 24 months time limit. Dear SSC, in our opinion, right, you are liable for the payment of the more tax, but by file an original return, you paid only less tax. So I'm here with giving you 24 months time. Think upon it and pay the remaining tax liability. So if you want to file an updated return and if you want to reduce your tax liability, not possible. If you want to file an updated return, want to claim a refund which you earlier omitted, not possible. So updated return can be accepted by the department only when a case where your tax liability is increasing at the time of updated return. You can't even claim the losses which you earlier forgot by filing an updated return. No, you cannot. So that's why I said it is more beneficial to department. Are you following or not, my every one of you? Sir, whether the filing of updated return is mandatory? No, it's optional. Filing of updated return is purely at the option of the SSC. Department not forcing you to file an updated return. Are you following or not? Then you may ask me, sir, from what point of view filing an updated return is beneficial to SSC? I understood that Update return is beneficial to department. How that updated return concept is beneficial to department, I understood. But how it is beneficial to SSE? Suppose that now during the running previous year 2020 to 23, assume that I have earned an amount of 5 crores. But at the time of filing of the original return, I am showing my income as only 2 crores. So that means I have escaped 3 crores income from the payment of income tax. But later on, after 15 months, I got to know that it's very risky to escape the income from the payment of taxes. Now, the income tax department is strictly taking the actions about those tax fraudsters. So then immediately I realized my mistake, right? And immediately I filed an updated return by disclosing this 3 crores income. I've disclosed this 3 crores as my income, and accordingly, whatever the tax liability came, whatever the interest is came, whatever the cess is came, right? I am paying all this, and then I can easily show that okay, the entire 5 crores is my disclosed income. There is not any rupee undisclosed to income tax department. So I can save myself from the adjudication, from the this proceedings, prosecution. Yes or no? So you have time limit of 24 months to disclose undisclosed income. Yes or no? Right? And nowadays, if you want to go for any loan, the bank are asking your last 2 years income tax returns. Earlier, since the time limit is there for 2 years for the filing of belated return, so the 2 years returns we can file within a gap of 1 month or 2 months. But now recently the time limits have been reduced. A belated return can be maximum filed up to 31st of December assessment year only. If the time limit of 31st of December completed, then no one can file a belated return. So for those who are going for the loans, it becomes very difficult for them to file the 2 years return within a gap of 1 month or 2 months. Now, such kind of SSEs can take the advantage of this provision. They can file an updated return. Are you following or not, Amma? Every one of you. Right, sir? Next. Next. So now just look at the theory part, Amma. Option to file the updated return of income. So clearly mentioned option. The option is given to SSE. Any person may furnish an updated return of income or the income of any other person for which he is assessable for the previous year relevant to the assessment year at any time within 24 months from the end of the relevant assessment year. And this is irrespective of whether or not he furnished the regular return, or he furnished a belated return, or he furnished a revised return. Even if you file a revised return, you can update the return. Updated return can be filed, absolutely no problem. Now, for an example, an updated return for the assessment year 23-24 can be filed till 31st of March 2026. That is what we have written here now, right? An SSE can file an updated return on or before 31st of March 2026 relating to the assessment year 23-24. Okay, next. Non-applicability of the provisions of updated return. The provisions of updated return would not apply if the updated return of such person for that assessment year is a loss return, right? So loss return cannot be updated. So against to a loss return, you cannot file an updated return. Are you following? Suppose that I filed a loss return saying that I have a business loss of 10 lakhs. But later on, I find that from that business, I got a loss of 15 lakhs. So I forgot to disclose 5 lakhs additional loss. Now, can I file an updated return for disclosing this additional loss of 5 lakhs? No, you cannot. You cannot. So against to a loss return, you cannot file an updated return. Next. And the provisions of updated return would not apply if that effect of decreasing the total tax liability. The updated return cannot be filed, right, if that results in refund or increases the refund. I've already mentioned you. By filing an updated return, you cannot reduce your tax liability and you cannot claim refund. If it has happened to be your total tax liability is reducing, if it's happened to be you are eligible, you are becoming eligible for a refund, then that updated return cannot be accepted by the software itself. Are you following or not? So you can file an updated return where only when your income tax liability is increasing. Earlier in the original return, your tax liability is only 1 lakh. Now by filing an updated return, you're showing income tax liability of 3 lakhs. So your tax liability increasing, the software will happily accept the updated return. Right, sir? Next. Circumstances in which the updated return cannot be furnished. No updated return can be furnished by any person for the relevant assessment year where an updated return has been furnished. So you already filed an updated return, right? So, sir, I filed an updated return. I'm agreeing, but in that updated return also there are some mistakes. Now, can I update the first updated return? No, you cannot. See, you can revise the revised return. First revised return, second revised return, third revised return. You can file n number of revised returns within the time limit of 31st of December assessment year. But that same provision is not applicable in the case of updated return. Once an updated return is filed, it is full and final. You are not allowed to make any changes in that updated return. So for any assessment year, you can file the updated return only once. You can file the updated return only once. Next, or any proceedings or assessment or reassessment or recomputation, revision of income is pending. Sir, I would like to file an updated return with respect to the relevant assessment year 23-24. Okay, Babu, you can file, but there is a problem, sir. Already against to me, there is some assessment proceedings are going on. Search assessment proceedings are going on already. Wait, wait, wait. You cannot file an updated return. If already assessment proceedings are commenced, now you cannot file an updated return. Okay, next. So updated return cannot be furnished by the assessee if he is such person or belonging to such classes of person as may be notified by the CBDT. If CBDT notified that yes, these classes of persons are not eligible to file the updated return, they are not eligible. That's it. So CBDT reserved its right to put restriction on certain classes of person from non-filing of the updated return. Next. So there are other circumstances also on which the updated return cannot be filed for the relevant assessment year. For example, where prosecution proceedings are initiated. If prosecution proceedings are already initiated against you by the department personnel, you cannot file the updated return. Okay. So what are those circumstances? We will discuss at the final level and not important at CA inter level. Of course, not covered at CA inter level. Okay. Next. Updated return can be filed if the original return is a loss return and the updated return is a return of income. Sir, just now you only told no, against the last return, you cannot file an updated return. Yes, I'm still stick on to those words. But here what they are saying, updated return can be filed if the original return is a loss return. Yes. Sir, you only giving the two contradictory statements. Not correct, sir. Wait, nah. See, you cannot file an updated return against your loss return. But you can file an updated return against your last return. After filing the updated return, it is becoming a return of income. Income tax return means, sir, in the original return, I filed the original return and I've showed a 5 lakhs business loss. Now I am filing an updated return where I am showing a return of income. Means I forgot to disclose certain incomes in my original returns. By disclosing that original incomes, now I am overcoming the losses. Now I am falling into the income. Are you following now? Every one of you. Sir, I happen to do two businesses. From one business, I got a loss. From the other business, I got a profit. Now, the loss of this business setting up with the profits from that business and my finally ending up with the return of income. Income is there, no losses. So by filing an updated return, you are saying that, yes, sir, earlier I filed original return where I booked 5 lakhs loss. But now I'm updating my return. I'm not having any more losses. That losses have been already set off. And now I'm showing an income. I'm showing an income. So this is my updated return where there is an income of 10 lakhs rupees. So by filing an updated return, you cannot increase your losses. Are you following now? But by filing an updated return, if the loss return turned to be an income tax return, you are showing an income in that updated return, that is acceptable. So you can see, if any person has a loss in any previous year and has furnished a written of loss, on or before the due date, he shall be allowed to furnish an updated return if such updated return is a return of income. So you're not anymore disclosing losses. Said that original return, I booked a loss now that already been set off, and now I'm showing a income. Okay, accept the updated return. Okay, next. Updated return to be furnished for subsequent previous year in case number 4 above. What happens, Amma? I'm explaining you with the help of the notes. Suppose that now in this you have filed a loss return on it, right? Now this loss return turns to be an income return at the time of filing the updated return. Now for the assessment year 2024-25, again your original return is happened to be a loss return. Now this should be updated again and it should be converted into income return. So once you filed an updated return in respect to any loss return, then that updated return concept has to be continued in the subsequent assessment years also. Now for the assessment year 2025-26 also, you happen to file a loss return. Now again this loss return should be updated and it should be converted into income return. So in the subsequent assessment years also, the assessee should, must file the updated return and has to convert that loss return into an income return. It's mandatory, compulsory. Okay, now. So that is what the next provision is. If the loss or any part thereof carried forward under Chapter 6 or unabsorbed depreciation carried forward, tax credit carry forward under section 115 JD, that AMT credit is to be reduced by any for any subsequent previous year as a result of the furnishing of the updated return, that then updated return is required to be furnished for each and subsequent previous years also. For next previous year also you need to file the updated return of income, and the subsequent assessment year also you need to file the updated return of income. It's mandatory, compulsory. Okay, ma, every one of you. So whatever the discussion so far we have done, that discussion is very much important from examination point of view. Very, very important. Okay, ma, everyone, right? Next. From here onwards, they also updated written amendment only, but not so important. Not so important. So far, we have seen the written filing procedure. Now we are going to see the tax on updated return. Sir, I'm filing the updated return. I already told you that whenever you are filing an updated return, the department accepts the updated return only when your tax liability increasing. By filing an updated return, you cannot reduce your tax liability. By filing an updated return, you cannot claim a excess refund, right? But you can pay higher tax liability by filing an updated return. Now that tax liability, how to calculate? There are different circumstances. Let us see one by one, right, sir? So payment of tax, additional tax, interest and fee before furnishing the updated return of income. If no return furnished earlier, that means I have not filed any original return, any belated return, right? Still I can file updated return. Yes or no? Still I can file updated return. Now, at the time of filing of that updated return, whatever the income you are disclosing, suppose that I am disclosing an income of 10 lakhs. So my tax liability comes out to be some 1,17,000 rupees. Okay. So this 1,17,000 I have to pay to the department before furnishing my updated return. So here it including income tax, surcharge if any, health and education cess, and obviously interest for the delayed payment of tax, interest for the delayed furnishing of income, means 234A, 234B, 234C, wherever applicable, these interests you have to pay. Suppose that I have calculated all this, it comes out to be some 1,50,000 rupees. Now from this, if you already paid any advance tax, that advance tax should be deducted, right, sir? And if any tax has been deducted against to you in the form of TDS or TCS, that you have to be deduct. And you are if eligible for deduction of relief under section 89(1), this also you can deduct. And if you are having any AMT credit, this also you have to deduct. This also you have to deduct. And finally, whatever the tax liability left, that should be paid to the department on or before furnishing of the updated return. So you just calculate the total tax liability on the income you have mentioned in your updated return. From the total tax liability, deduct if any advance tax paid, deduct any TDS and TCS deducted against you, deduct if you are eligible for relief under section 89(1), and deduct AMT credit. And after deducting all this, whatever the tax left, that should be paid by the assessee. Okay, now next. So where no return of income furnished under section 139(1) regular return, 139 for belated return has been furnished by assessee, and tax is payable on the basis of updated return to be furnished by such assessee under section 139(8)(a). The assessee would be liable to pay the tax together with interest and fee payable. Okay, ma'am. Right? Under any provisions of the this act, for any delay in furnishing of the return, he has to pay interest under section 234A, or any default or delay in payment of advance tax, 234B interest and 234C interest, along with the payment of additional tax computed under section 140B subsection 3. And before furnishing of the return, all this have to be done. The tax payable is to be computed after taking into account the following: the amount of tax, if any, already paid as advance tax, TDS, TCS, relief under section 89, and any tax credit claimed, AMT credit. The return has to be accompanied by the proof of payment of such tax. Okay, next. If the return is furnished earlier, first case is that I have not even filed my original return or belated return. But this is a case where I have filed my original return. I have filed original return. Now in this case, same provisions applicable, amma. Suppose that by filing an updated return, my tax liability comes out to be 1,50,000 number. Now from this, what I have to deduct? The tax already paid by filing the original return or a belated return. See, at the time of filing of the original return or a belated return, you might have paid certain tax liability. Na? The tax liability you have to deduct, amma. Tax paid under section 140A1 minus the same thing again. Advance tax, if any, paid, minus TDS and TCS, minus relief under section 89(1), minus AMT credit. And the balance should be paid on or before furnishing of the updated return. See, what is the difference, Amma? Here we have deducted only advance tax, TDS and TCS, relief, AMT credit. Here, one additional amount we are deducting, that is taxes paid at the time of filing of the original return. Yes or no? See, this tax paid at the time of filing of the original return is not covered here because earlier you have not filed any return at all. But here you filed a return in which you paid certain tax liability. So the tax liability has to be reduced now while computing the tax liability and updated return. Yes or no? Every one of you. right? Next, additional income tax payable at the time of updated return. Sir, how much additional income tax I have to pay? Look at here. The additional income tax payable at the time of furnishing of the updated return is 25% of the aggregate of tax and interest payable as determined above. If such return is furnished after the expiry of time available under section 139.4 or 139.5 and before the completion of period of 12 months from the end of the relevant assessment year. That means I'll show you with the help of the notes, ma'am. This is our relevant previous year 2022-23, and this is our relevant assessment year 2023-24. 2023-24. Okay, ma'am. Now you have the time limit up to 31st of July for the filing of original return under section 139.1. You have the time limit of up to 31st of December for the filing of belated return or for the filing of updated return, revised return. So if you file either a belated return or a revised return within this time limit, means up to 31st of sorry uh, up to 31st of March 2024, 12 months time limit is given to you. 12 months before the completion of period of 12 months from the end of the relevant assessment year. Sorry, not up to 31st March 2024. Up to 31st March 2024, your assessment year will get completed. From here onwards, you have given 12 months time limit and up to 31st March 2025. Okay, now if that be the case, suppose that I am filing the updated return. I am filing the updated return on 31st of January 2025. Means well within the 12 months from the end of the relevant assessment year. My assessment year is ending on 31st of March 24. So from there 12 months time period means I can file my updated return up to 31st of March 2025. In that cases, the additional tax payable is 25% of the aggregate amount of tax and interest. Sir, what if the case for the filing of updated return, I have 24 months time limit now. So that means I can file my updated return. I can file my updated return up to 31st of March 2026. Yes. If you file the updated return after this 12 months time period, means in the second 12 months time period, you are filing updated return. In that case, the additional tax payable should be 50% of the aggregate of your tax and interest. The additional tax payable should be 50% of aggregate tax and interest liability. Suppose that your aggregate amount of the tax and interest comes up to be 20 lakhs, out of which 10% or 50% means 10 lakhs you have to pay as an additional tax while filing the updated return. Okay, ma'am. 50% of aggregate tax of interest payable as determined above if such return furnished after the expiry of 12 months from the end of the relevant assessment year, but before the completion of 24 months. Okay, ma'am. Next. Interest under section 234B, where earlier return has been furnished. Ma, what is interest under section 234B? Interest for the non-payment or short payment of advance tax. Non-payment of advance tax or short payment of advance tax. You are subject to pay the interest under section 234B. Okay, now. So generally, interest under section 234B, we will calculate on assessed tax. Sir, what do you mean by assessed tax? Assessed tax means be the tax liability, whatever we have disclosed in our return of income. But now here you have to take the assessed tax definition as the tax amount disclosed in the updated return. So it means the tax on total income as declared in the updated return. After taking into account the same thing, and tax early paid, tax of advance tax paid, TDS or TCS, AMT credit, the same provisions are these. Assessed tax means the tax on total income as declared in the updated return. Okay, now next. Forward to CBDT to issue guidelines. Sir, if you face any difficulties in this concept, then the CBDT has every right to issue guidelines to remove such difficulties. But of course, before issuing such guidelines, it will take the prior approval of the central government. And each and every guideline should be discussed in each of the house of the parliament. In Lok Sabha and Rajya Sabha, in both the houses, these guidelines will be discussed only. Then only they will be finalized, and then only they will be released only. Okay. Next, computation of additional income tax for the purpose of computation of additional income tax. Sir, means to be, sir, here tax means to be tax including surcharge and cess. Tax doesn't mean only income tax. Income tax, surcharge, health and education cess, all this put together we call tax under. Okay. The interest payable would be the interest chargeable under any of the provisions of this act under. Clear. Next. Interest under section 234A if no earlier return has been furnished. What is 234A, Amma? 234A is the interest on interest with respect to non-filing or belated filing of return. Return of income. Non-filing of return of income or late filing of return of income will attract 234A interest. So when it comes to updated return, how to calculate? Simple, Amma. In case where no earlier return has been furnished, the interest payable under section 234A has to be computed on the amount of the tax on total income as declared in the updated return. Next, interest under section 234C if earlier return has been furnished. 234C, C is missing, Omega. 234C. When 234C interest is applicable? For the defaults in payment of advance tax. Defaults in payment of advance tax. Then 234C comes into picture. Right, sir. So interest is payable under section 234C where an earlier return has been furnished and has to be computed after taking into account the income furnished in the updated return. Interest in default in furnishing of the return of income. 234A. The tax on total income as determined under section 143(1) would not include the additional income tax if any payable under section 140B or 143. The tax on total income determined under regular assessment would not include in the additional income tax payable. See, already tax on the regular return, you might have already paid to the department. On that, you might have already calculated 234A interest and you might have already paid. Suppose that if my original return I have filed belatedly, so I might have ended up paying the 234A interest already. Suppose that I have paid 234A interest 5,000 rupees. Now, when it comes to updated return, the interest amount comes out to be some 8,000. Out of 8,000, 5,000 I've already paid. So deduct that amount, only the 3,000 now I have to pay. Are you following, sir? So this is the concept of updated return. Okay, now the lengthiest amendment, but I have already told you that the important portion is up to this only. Up to this only. Tax on updated return also, you just have a look on it. It's also very easy, right? But from main exam point of view, I can say up to this you can be asked. Okay, so just go through it and ask the doubts if any, sir. You already have regular return, belated return, revised return, defective return, and new return has been added, updated return. So you must also update, not your return, your knowledge. Okay, sir. So that's all with the amendments from the chapter return of income. In the next session, we will discuss the amendments from the chapter TDS and TCS. So till then, have a good day and good night, sir. A very good morning, students. So welcome to the Straight Start Taxation classes. In the last session, we have completed discussion regarding amendments applicable for May 2023 and November 2023 examinations from the chapter return of income. Now it's time to learn the amendments from the chapter TDS and TCS. So in this chapter, we got two amendments. And the two are very important from examination point of view, right? So generally, in every examination attempt, there will be definitely a question from TDS and TCS, one question and one MCQ. So these two amendments, either you will get as a question for 4 marks, or you will get at least 2 MCQs. So the two most important amendments from this chapter. Okay, now let us see what are they. First one, the amendment came in section number 194 IA. Payment on transfer of certain immovable property other than agricultural land. Now, what is this section about? First, let us discuss this section, right? And then after that, we will see the amendment in this section. Okay, sir. So TDS and TCS, the next chapter. TDS and TCS. So in that we got amendment in section number 194 IA. Suppose that there are two persons, Mr. X and Mr. Y. Mr. X transferred a residential house property to Mr. Y. Now he is a transferor, he is a transferee, right, sir? So X transferred a residential house property to Mr. Y. Now Mr. Y has to pay the consideration. Consideration agreed to be paid. Let us assume 60 lakhs rupees. 60 lakhs rupees. Now here, Mr. Y, while remitting this amount to Mr. X, he has to deduct the TDS at the rate of 1% under section 194 IA. Since here the consideration amount exceeding 50 lakhs rupees. We have learned under section 194 IA, threshold limit of 50 lakhs rupees. So Mr. Y, while making the payment to Mr. X, he has to deduct the TDS minus TDS at the rate of 1% under section 194 IA. So which comes out to be some 60,000 rupees. So net consideration to be paid in the 59.4 lakhs. Net consideration to be paid to Mr. X. This is the existing provision. Now, what is the amendment? Suppose that, sir, let us take the same example. First, suppose if the consideration agreed to be paid 49 lakhs, whereas the stamp duty value of the property 51 lakhs. The stamp duty value of the property 51 lakhs, but the consideration agreed to be paid 49 lakhs only. Both the parties are agreed to it. Now, in this question, in this scenario, tell me whether TDS under section 194I applicable or not. 194 IA applicable or not. The threshold limit is 50 lakhs. So threshold limit means to be what? Should I take the consideration into factor, or should I take the stamp duty value of the property into the consideration? The answer is, before the amendment, the threshold limit is consideration amount. Irrespective of the fact whether the stamp duty value of the property exceeded 50 lakhs or not. If the consideration paid exceeding 50 lakhs, now the payer, that means the buyer, is under an obligation to deduct the TDS under section 194 IA. In this scenario, since the consideration amount is 49 lakhs, means less than 50 lakhs, no TDS is required to be deducted. But this is the old provision. Now the amendment says threshold limit means to be consideration or stamp duty value, whichever is higher. Whichever is higher. Earlier, what is the provision, Amma? TDS is equal to 1% of consideration. 1% of consideration. But now the new provision is, the amended provision is TDS is equal to 1% of consideration or stamp duty value of the property, whichever is higher. Whichever is higher. So this is the old provision which you can ignore. Now this is the amended provision. So now we have to see the consideration amount and as well as stamp duty value of the property. Take these two, take the higher amount, apply 1%. That's it. Are you following or not? See, even if the consideration paid is less than 50 lakhs, if the stamp duty value of the property exceeding 50 lakhs, you need to apply the TDS provisions. You need to apply the TDS provisions under section 194 IA. That's the amendment from this section. Clear, sir? Every one of you. Completed, sir. Now let us look into the amendments material. So applicability and rate. Every transferee is responsible for paying any sum as consideration for the transfer of immovable property, land other than agricultural land, building or part of the building to a resident transfer, shall deduct the tax at the rate of 1% of such sum, means 1% of consideration, or this is the amendment only, or the stamp duty value of such property, whichever is higher. Here agricultural land means to be rural agricultural land, right? For the purpose of this section, it means rural agricultural land. In other words, right, transfer of urban agricultural land will attract the provisions of section 194 IA if the consideration or the stamp duty value of such land is 50 lakhs or more. So the threshold limit is tax is not required to be deducted at source where the total amount of the consideration for the transfer of the immovable property and the stamp duty value of the property are both less than 50 lakhs. So as long as the consideration amount less than 50 lakhs, less than or equal to, and the stamp duty value of the property less than or equal to 50 lakhs, in this case 194 IA provisions are not applicable. Both consideration should be less than or equal to 50 lakhs and stamp duty value of the property should be less than or equal to 50 lakhs. As long as this situation prevails, 194 IA provisions not applicable. Clear, ma? So 194 IA comes into picture, either consideration exceeding 50 lakhs or stamp duty value exceeding 50 lakhs. Then only 194 IA comes into picture. Next, the second amendment 194R. 194R, deduction of tax at source on the benefit of perquisite in respect of the business or profession. So initially 194 IA, let us see in our material. 194 IA, 50 lakhs actual consideration. Now it becomes what, Amma? What you have to write here? Actual consideration or stamp duty value. Actual consideration or stamp duty value. And here it is now 1% of consideration or stamp duty value, whichever is higher. Whichever is higher. Clear, ma? Every one of you. Next, 194R. So applicability and rate of TDS. Sir, what is this section 194R? First, let me explain you the background of this section. section 194R. Let's take an example. There are two persons, Mr. X, Mr. Y. Mr. X and Mr. Y. Mr. X providing some benefits or providing some gifts to Mr. Y. Right, sir. Here Mr. X is a giver and Y is a recipient. Now, the relationship between the X and Y could be anything. Could be anything. Means X an employer, Y an employee. X is a business person, and Y is a customer. Y is a customer. X is a professional person, a professional, and Y is client. Are you following, sir? Every one of you. The relationship could be anything, right? Now here, if the relationship between the X and Y is employer and employee, employer providing any benefits or gifts to Mr. Y, his employee. Now this is forming part of the total income of Mr. Y, right? This will be taxable under the head income from salaries in the hands of Mr. Y. And now Mr. X is under an obligation to deduct the TDS under section 192. TDS under section 192. Whatever the benefits or gifts provided by the employer to the employee is forming part of salary income of the employee. So the employer is under an obligation to deduct the TDS under section 192. Okay, ma'am. In case if the relationship between X and Y is a business person and a customer, or a professional person and a client, now this will be taxable in the hands of Mr. Y under the head PGBP. Right, sir? Now here, Mr. X is under an obligation to deduct the TDS under section 194R. Under section 194R. This is the background of the section. But of course, the aggregate amount of the benefits or gifts amount should exceed 20,000 rupees. The aggregate amount of the gifts or benefits provided must exceed 20,000 rupees. Then only TDS under section 194R provisions applicable. And the TDS rate, what is the rate of TDS, ma? 10%. 10%. Okay, sir. So now this is the background of the section. Now you can look at it. Applicability and rate of TDS. 194R requires any person who is responsible for providing to a resident any benefit or perquisite, whether convertible into money or not, arising from the business or the exercise of a profession by such a resident, to ensure before providing such benefit or perquisite as the case may be to such a resident, the tax has been deducted in respect of such benefit or perquisite at the rate of 10% of the value or aggregate value of such benefit. Right, sir? So the benefits received or the perquisites or gifts received in the course of business or profession only attracts section 194R. Cases where benefit or perquisite is wholly in kind or partly in kind and partly in cash. Suppose that, example, there are two persons, Mr. Ram, who is happened to be a doctor, right? And there is one of his patient, Mr. Sham, the patient of this doctor. This doctor conducted a surgery, very, difficult surgery, a typical surgery successfully, right? And Mr. Sham survived from a severe injury. Now, as a matter of gratitude, Mr. Sham giving him, that means to the doctor, a car as a gift worth rupees some, uh, let us assume 20 lakhs. Right, sir. So as a matter of gratitude, Mr. Sham wants to give him a car worth rupees 20 lakhs. Now, Mr. Ram is a doctor here. He's a professional person. He's a professional person, right? So Mr. Ram is receiving a gift in the course of his profession. Now here TDS under section 194R comes into picture. Who is a giver here? Mr. Sham is a giver. He is giving the car, na? Now Mr. Sham is under an obligation to deduct the TDS under section 194R. So what is the TDS amount, Amma? TDS is equal to the value of the gift giving 20 lakhs into rate of TDS 20%, 10 percentage, 2 lakhs, Amma. 2 lakhs. Suppose that if this benefit amount is in cash, so we can easily deduct the 2 lakhs as TDS and we can give 18 lakhs to the doctor. But this is completely in kind. Then how can we deduct the TDS? Yes or no? Right? So then here the resident, in this case, the doctor has to make the necessary arrangements for the TDS. Now, Mr. Sham has to receive the TDS amount in cash, 2 lakhs, or in check. Sir, I would like to give you a car worth 20 lakhs, but 194 are attracting me. I have to deduct the TDS. The TDS amount comes out to be 2 lakhs. So give me 2 lakhs. Give me 2 lakhs. That was what you are only giving the gift to me. I'm not asking any gifts, but you are giving gift to me. And at the same time, you're also asking me a TDS amount of 2 lakhs. I don't want your gift. Who said like that? No one, na. See, if you give 2 lakhs, you are getting 20 lakhs worth of car, na. Yes or no? So generally, that's why if the gift amount, if the benefit amount is completely in kind or partially in kind, then the resident payee, the resident should make the necessary arrangements for the TDS amounts. So the giver has to give the gift or benefit to that recipient only after receiving the sufficient amount for TDS. Clear, Amma? So look at here. In a cases where the benefit or perquisite, as the case may be, is wholly in kind or partly in cash, partly in kind, but the part in cash is not sufficient to meet the liability of the TDS. In respect of whole of such benefit or perquisite, the person responsible for providing such benefit or perquisite shall, before releasing the benefit or perquisite, ensure that the tax required to be deducted has been paid in respect of such benefit or perquisite. So before releasing of the gift, clearly mentioned, before releasing the benefit, he has to make sure that the tax required to be deducted has already been paid in respect of that benefit or perquisite. Clear, ma? Next. Non-applicability of TDS under section 194R. One case I've already mentioned to you, that is the aggregate amount of the gifts, right, should exceed 20,000 rupees for the attraction of this TDS. So that means if the aggregate amount of the benefits or perquisites or gifts provided in a financial year not exceeding 20,000 rupees, then 194R provisions not applicable. That is the first case. You can see no tax is required to be deducted under section 194R in the following cases. In a case of a resident where the value of the aggregate value of the benefits or perquisites provided are likely to be provided to such a resident during the financial year does not exceed 20,000 rupees. The first exception, as long as the aggregate value of the benefits received or gifts received or to be received not exceeding 20,000 rupees, 194R provisions not applicable. Next, the second exception, in the case of an individual or HUF whose total turnover not exceeding 1 crore, whose gross receipts not exceeding 50 lakhs. These people are not subject to deduct the TDS under section 194R. Whose turnover not exceeding 1 crore, whose gross receipts not exceeding 50 lakhs during the preceding previous year. Now, in the current financial year, in the current previous year, 194R provisions are not applicable to them. Look at here. In the case of individuals or HUF, whose total sales, gross receipts, or turnover from the business or profession does not exceed 1 crore in the case of business, does not exceed 50 lakhs in the case of profession. during the financial year immediately preceding the financial year in which such benefits are perquisite, as the case may be, is provided by such person. Next, power of CBDT to issue the guidelines. So while you are applying these provisions under section 194, or if you are facing any difficulties, the CBDT has every right to issue the guidelines to remove such difficulties with the prior approval of the central government. And each guideline, it is going to be issued before going to be issued, that each and every guideline will be discussed in both the houses of the parliament, then only it will be issued in the official gazette only. Next, so who is said to be the person responsible for providing? That means whoever the person providing such benefit or giving such benefit is called as the person responsible for providing. Are you following or not, sir? Suppose that I am giving a gift of 10 lakhs worth of rupees to my advocate because he won a case in favor of me. So I would like to give him a gift worth of 10 lakhs rupees. Now, I am the person responsible for providing. Are you following or not, Amma? So you can see person responsible for providing means the person providing such benefit or perquisite. Whoever providing such perquisite is called person responsible for providing. Clear, Amma? Right. So these two are the amendments from the TDS and TCS. So these two amendments are very important amendments, Amma. So one should be very, very careful. For May 2023 exams, definitely you will get a question or at least an MCQ or two MCQs. Okay, Amma? Right. So in the next session, we'll come up with the amendments from the chapter problems on total income. Okay, sir. Till then, have a good day and good night, sir. A very good evening, students. Welcome to the Straight Taxation classes. We are discussing the amendments from the various chapters for May 2023 and November 2023 exams. So in the last session, we have completed the amendments from the chapter TDS and TCS. Okay, ma. Now, time for the amendments from the chapter problems on total income. Generally, in the problems on total income, amendment means to be, in the problems on total income chapter, we have discussed only the problems and consolidated problems, right, sir? So, which contains the provisions from all the five heads of incomes, provisions from clubbing provisions, set off and carry forward of losses, chapter 6A deductions. Yes or no? Problems on total income. Total income problems are nothing but consolidated problems. Now, here I am going to discuss about one problem because which involving capital gains, right? Due to change in the previous year, due to change in the indexation factor, for the previous year 21-22 it is 317, for the previous year 22-23 it is 331. So indexation factor changed. So whenever there is an involvement of the capital gains, the answer will get changed. So that's why I've solved out this one problem, sir. Right? So you can see Rosie and Mary are sisters, born and brought up at Mumbai. Indian citizens. Since they born in India, Indian citizens. Rosie got married in 1982 and settled at Canada since 1982. So after her marriage, she shifted to Canada and she was settled there itself. So that means what, mom? The residential status of Rosie, we can say non-resident, because she neither satisfying B1 condition nor B2 condition. What is B1 condition? 182 days or more, the period of stay in the India during the current previous year, not satisfied. And B2 condition, 60 days or more during the relevant previous year, period of stay in India, and 365 days out of the 4 preceding previous years. She was settled in Canada since 1982. She never come back to India after her marriage. So both B1 and B2 conditions are not satisfied. She is straight away non-resident. So Rosie, residential status, non-resident. Coming to Mary, Mary got married and settled in Mumbai. So the residential status of Mary is resident and ordinarily resident. She settled in Mumbai. So she is continuously living in India only. B1 condition satisfied, and both A1 and A2 conditions are satisfied. So resident and ordinarily resident. Both of them are below 60 years, so normal citizens. The following are the details of their income for the previous year, 31st March 2023. So we are provided with some income details, and after that, finally, they are asked to find out, compute the taxable income and as well as the tax liability of Mrs. Rosie and Mrs. Mary for the assessment year 23-24. Ignore the provisions of section 115 BAC. That means what, Amma? Concessional tax rate provisions, just ignore. They are opting for regular taxation provisions only. Okay, sir. Every one of you. Now, let us see one by one. First, pension received from state government. Here only Mary is receiving the pension. Mary means what? Who settled in Mumbai, India. Resident and ordinarily resident. In the hands of the resident and ordinarily residents, both Indian income and foreign income, both are taxable. If your residential status happen to be resident and ordinarily resident, both Indian income and as well as foreign income, both are taxable in your hands. Yes or no, sir? Okay. Now, so in the hands of Mary, this is taxable. Taxable under the head income from salaries. Pension income kadama 60,000 rupees. So this you have to take it as gross salary, from which you can deduct standard deduction under section 16 clause 1A 16A. So whereas uh, 50,000 rupees you can deduct the standard deduction. So income from salaries 10,000 rupees amma. Okay, so you can see computation of taxable income of Mrs. Rosie and Mrs. Mary for the assessment year 2023-24. So salary income, pension received from state government 60,000, right? And less standard deduction 16 clause 1A 50,000. So net salary income taxable 10,000 rupees. Okay, sir. Every one of you. Next. Pension received from Canadian government, and this pension is received by Rosie. So first of all, what is the nature of income here? Pension received from Canadian government. So the income was accrued outside the India and received outside the India. So when an income is accrued and received outside the India, it is a foreign income. It is a foreign income, and foreign income not taxable in the hands of non-residents. So this 20,000 not taxable in the hands of Rosie, as it is a foreign income and Rosie's residential status is non-residents. In the hands of the non-residents, only the Indian income taxable. Yes or no, sir? So that's why the explanation provided here. Pension received from Canadian government is not taxable in the case of a non-resident, since it is earned and received outside the India. Okay, sir. Next. Long-term capital gains on sale of land at Mumbai. This is Indian income. Indian income fully taxable in the hands of Rosie and as well as in the hands of Mary. That's Indian income because the land is situated in India. So that means the place of accrual in India, and you're receiving the money in India. So either place of accrual or place of receipt, if anyone is situated in India, the nature becomes Indian income. If the nature is Indian income, it is fully taxable irrespective of the residential status of the assessee. So long-term capital gains 1 lakh, 1 lakh. So just some alignment is missing here. So long-term capital gains taxable in the hands of Rosie and as well as Mary. Next. Short-term capital gains on sale of shares of Indian listed companies in respect of STT was paid. Short-term capital gains in respect of Indian listed company shares. So the nature of income is Indian income. Fully taxable in the hands of both Rosie and as well as in the hands of Mary. So check it out. Short-term capital gains. Short-term capital gains 20,000, 2,50,000. The total capital gains taxable 1,20,000 in the hands of Rosie, 3,50,000 in the hands of Mary. Okay, mom. Next. Premium paid to Canadian Life Insurance Corporation at Canada. Sir, will this be eligible for deduction under Section 80C? Answer is absolutely yes. You can claim. Mediclaim policy premium paid by account paycheck. Section 80D, we can claim deduction. Deposits in PPF, Section 80C, we can claim deduction. Section 80C. Rent received in respect of the house property at Mumbai. Since the property is situated in India, the place of accrual is said to be in India, the nature becomes Indian income. And I already told you that if the nature is happened to be Indian income, it is fully taxable in the hands of the assessee, irrespective of his residential status. So 60,000 and 30,000. This you have to take it as gross annual value, from which you have to deduct the standard deduction at the rate of 30%. So 18,000, 9,000. So NAV, which is the income from house property here, 42,000 and 21,000. Okay, ma, that's income from house property. Check it out. Income from house property. So GAV 60,000, 30,000 minus standard deduction. Then you'll get 42,000 and 21,000 taxable in the hands of Rosie and as well as Mary. Now you can see the gross total income. How much, Amma? In the hands of Rosie, she's not having any salary income. She's having house property income 42,000 and capital gains 1,20,000. That's it. So 1,62,000 is a gross total income of the Rosie. And coming to Mary, she's having salary income of 10,000 rupees, house property income of 21,000 rupees, and capital gains income of 3,50,000 rupees. So 10 plus 21, 31 plus 350, 381. 3,81,000 is a gross total income of the Mary. Now look at the chapter 6A reductions. First, LIC premium paid 10,000 rupees. In the case of Mary, LIC premium paid 10,000 rupees. Right, sir? And LIC premium paid to Canadian government 40,000. Deposits into PPF 20,000. So under Section 80C, 40,000 and 30,000. Under Section 80D, Mediclaim policy premium is at 25,000. Total Chapter 6A reductions 1,40,000 and 55,000. Deduct it, Amma. Gross total income 1,60,000 minus total Chapter 6A reductions 40,000. The taxable income 1,20,000. In the hands of Rosie. In the hands of Mary, gross total income 3,81,000. Total Chapter 6A deductions 55,000. So deduct it, Amma. The total income is 3,26,000. Okay, now time for the calculation of tax liability. Now this I will explain you with the help of the running notes. Problems on total income. Problem number 1. So up to the calculation of total income, we have done it, Amma. Now calculation of tax liability. Calculation of tax liability in the hands of Rosie. So what is the total income of the Rosie? Total income of the Rosie is equal to 1,22,000 rupees. Am I right? Yes, 1,22,000 rupees. So this 1,22,000 rupees, the entire amount is general income. Are there any special incomes involving? Yes. Long-term capital gains under section 112, short-term capital gains under section 111A. These two are special incomes. These two are special incomes for which special tax rates are available, sir. Okay, now when it comes to Rosie, she's having long-term capital gains under section 112 rupees 1 lakh. Then short-term capital gains under section 111A rupees 20,000, and the remaining 2,000 you can take it as general income. So the general income she's having is 2,000 rupees a month minus basic exemption limit. Since the age of the assessee less than 60 years, basic exemption limit is 2,50,000. So unexhausted basic exemption limit 2,30,000 rupees. Unexhausted basic exemption limit 2,30,000 rupees. Now my question is, sir, whether this unexhausted basic exemption limit can be utilized for the payment of, sorry, for the special incomes here. Unexhausted basic exemption limit. Can I utilize this 2,30,000 for my special incomes? Answer is absolutely no, you cannot. Sir, you only said now in the chapter capital gains, if we have unexhausted basic exemption limit, we can be utilized 8 for the long-term capital gains under section 112, short-term capital gains under section 111A. You only said now, yes. But again, why, sir, you are saying you cannot utilize? Why? Why? Because the residential status. Rosie's residential status is non-residents. So the benefit of the utilization of unexhausted basic exemption limit towards your special income is applicable only for resident assessees, not for all the assessees. So you cannot utilize this unexhausted basic exemption limit for your long-term capital gains or short-term capital gains. Okay, ma. Since the Rosie residential status is non-resident. So find out the tax liability, Amma. So here tax liability comes out to be 1 lakh into a flat rate of 20 percentage, 20,000 rupees. And here tax liability is equal to 20,000 into 15 percentage, 3,000 rupees. So what is the income tax you are getting, Amma? The total income tax, 23,000. Add health and education says, sir, can I claim rebate benefits here? Rebate under section 87 capital A, can I claim? Answer is no, you cannot. Again, the rebate benefits are available only for resident assessees. Even though here the assessee's total income is less than 5 lakhs, but still he is not eligible for rebate because Rosie's residential status is non-resident. So straight away you can go for health and education says at the rate of 4 percentage, 23,000 into 4 percentage, 920 rupees. So the total tax liability of Mrs. Rosie, total tax liability of Mrs. Rosie, 23,920 rupees. Okay, ma, you can check it out. The total tax liability of Mrs. Rosie, 23,920 rupees. Okay, sir. Now let's time for the calculation of the total tax liability of Mrs. Mary. Calculation of total tax liability of Mrs. Mary. What is the total income, sir? Total income of Mrs. Mary, 3 lakhs 26,000. 3 lakhs 26,000. And any special incomes? Yes, sir. Again, long-term capital gains under section 112, rupees 1 lakh. Short-term capital gains. How much? Short-term capital gains she is having how much amount? 2,50,000. Short-term capital gains under section 111A, 2,50,000. and the other income. Of course, you can find out here, Amma, the total income she's having only 3,26,000. 3,26,000. Okay, now. So here these two incomes comes out to be 1 lakh long-term capital gains and 2,50,000 short-term capital gains. So here you can take as this 76,000. Long-term capital gain is 76,000 and short-term capital gain is 2,50,000. Okay, mom. Every one of you, right? Or else you can do like this. 1 lakh long-term capital gains now, right? Of course, here you can see uh, how much chapter 6 deductions we have given, sir. 25, 55,000 we have given. 3,81,000. We have to make a restriction here actually. Are you following, sir? We have to make a restriction here in the chapter 6A deductions. Total deduction under chapter 6A restricted to income other than capital gains taxable under section 111A and 112. So basically here, chapter 6A deductions are not available against to the long-term capital gains and short-term capital gains. Special incomes. Are you following, sir? See, apart from the capital gains, what are the general incomes she's having, sir? 10,000 salary income and 21,000 house property income. So that means here the chapter 6A reductions should be restricted to 31,000, sir. 31,000. In that case, it would be 3,81,000 minus 31,000. So the total income should be 3,50,000. This is correct calculation. 3,50,000. So total income you have to take what, Amma? 3,50,000. General income nil. Okay. Now, sir, since the general income is nil, the entire amount of the basic exemption limit is said to be unexhausted. Unexhausted basic exemption limit, 2,50,000. Now, this unexhausted basic exemption limit can be utilized for these special incomes. Answer is absolutely yes, since Mrs. Mary is a resident assessee. So first utilize for your long-term capital gains because it is taxable at a higher rate of 20%. So utilize 1 lakh here. The remaining 1,50,000 utilize here. Unexhausted basic exemption limit. After utilizing this, the net short-term capital gains taxable is 1 lakh only. Whereas the tax liability comes out to be 1 lakh into 15%. 15,000 rupees. This is your income tax minus rebate under section 87 capital A. Because assessee is a residential assessee, resident assessee, and the total income of the assessee not exceeded 5 lakhs. So we can claim a rebate under section 87 capital A up to a maximum of 12,500 rupees. So finally, the net income tax 2,500, and health and education says at the rate of 4%, which comes out to be 100 rupees. So the total tax liability of Mrs. Mary is equal to 2,600. Total tax liability of Mrs. Mary is equal to 2,600. You can check it out, Amma. 2,600. So that's the problem from the problems from total income. So the tax liability computation should be very careful since you are having unexhausted basic exemption limit. That calculation part also very, very careful, Amma, every one of you. So with this, we have completed the entire income tax amendments except capital gains. Of course, in the capital gains also, we have one amendment only, that is change in the indexation factor. There is one more amendment regarding stamp duty value in the slum sale concept, which you know already. Apart from that, cost inflation index change it from 317, which is applicable for 21-22. Now for the 22-23, it changed it to 331. Since the cost inflation index factor is changed, all the problems have been reworked. Okay, ma, every one of you. So that's it for this session. Next session will start with capital gains. Okay, ma. See you in the next session. A very good evening, students. Welcome to the stress test taxation classes. We are discussing the amendments applicable for May 2023 and November 2023 exams. So far, we have completed all the amendments from the income tax except capital gains chapter. Right, sir. Now, time for the capital gains. In this, the very first amendment, we can say cost inflation index, CII, cost inflation index factor. That will be the very first amendment in the capital gains chapter. We have already seen that cost inflation index for the previous year 2021-22, the cost inflation index is 317, which is applicable for May 2022 and November 2022. Now, for the May 2023 and November 2023, the corresponding previous year is 2022-23, and the cost inflation index applicable is 331. 331. For every previous year, we will be having a separate cost inflation index. Yes or no, sir? Right? So now this cost inflation index is relevant for the May 2023 and November 2023 exams. This is a very first amendment. Now, because of this amendment, each and every problem of the capital gain have been reworked again, because all the capital gains problems will be containing that calculate the capital gains for the previous year 2022-23. Since we are asked to find out the capital gains for the previous year 2022-23, we need to use the cost inflation index 331. All our capital gains problems have been worked out based on the previous year 21-22. When I was prepared this material, that is in the July August time period, 317 is the cost inflation index. Now it is 331. So that's why each and every problem have been worked out. Now all that problems we are going to be discussed in this amendments session. Okay, sir, every one of you. Before going into the problems for classroom discussion, we have a very small amendments, out of which the first one I've already discussed in my regular classes, right? If you have already taken my subscription classes and already attended my classes, this you might have already observed. Like, what is this, sir? See, the two small amendments are from the chapter, from the topic slum sale. Section 50, capital B, slum sale. Right, sir? What do you mean by the slum sale? Transfer of a business unit undertaking for a lump sum consideration without assigning the values to the individual assets. Right, sir? If you are selling an individual asset, that's not a slum sale. If you're selling a business unit as a whole, a business undertaking as a whole, that is what you call slum sale. Okay, ma. Now, in that concept, we got two small amendments. The number one is regarding the fair market value. While calculating the capital gains when it comes to the slum sale, what is the full value of consideration, amma? Full value of consideration is equal to the amount of the consideration received in kind plus the amount of the consideration received in cash. Sir, amount of the consideration received in kind means what? You have to take the fair market value of the consideration received in kind. Sir, what do you mean by the fair market value? What do you mean by the fair market value here? So for that purpose, we got an amendment here. Generally, we will take the fair market value as in the date of transfer. But now the amendment said it is the higher of the fair market value of the capital assets transferred by way of slum sale and determined on the date of slum sale, determined as on the date of transfer. and the fair market value of the consideration received received or accruing as a result of the transfer by way of slump sale, which including the both monetary and as well as non-monetary, including both monetary and as well as non-monetary. So among these two, you have to take the higher one. That will be your full value of consideration. You can see here the fair market value of the capital assets as on the date of transfer calculated in the prescribed manner. What is the prescribed manner? This is a prescribed manner. This is a prescribed manner. Okay, ma. Shall be deemed to be the full value of consideration. Right, sir. So accordingly, CBDT has prescribed that for the purpose of section 50B to clause 2, the fair market value of the capital assets would be the higher of whichever is higher. Okay, now. So this is your first amendment, right? The comparison between the fair market value of the capital assets transferred, right? Whatever the capital asset you have transferred, such capital assets fair market value you have to take, and whatever the consideration you have received, both monetary and as well as non-monetary. So both of that assets fair market value you have to take. Now, among these two, the higher one will be your full value of consideration. Clear, ma? So that's the first amendment. Now the second amendment is if you look at the definition of slump sale, it started with the words sales, sale of a business unit as a whole, sale of a business undertaking as a whole. Now this word sales is replaced with the word transfer, replaced with the word transfer. Now you have to read the definition as transfer of a business unit as a whole, transfer of a business undertaking as a whole for a lump sum consideration without assigning the values to the individual capital assets is called slump sale. Earlier, how the decision we used to study, Emma? Sale of a business unit as a whole, sale of a business undertaking as a whole. Now the words sale replaced with the word transfer, because transfer includes sales, transfer includes exchange, transfer includes extinguishment, transfer includes a relinquishment, transfer includes conversion of a capital asset into stock in trade. There are many things covered under the definition of transfer. Are you following or not, Amma? Every one of you. Right. So, therefore, Finance Act 2021, the definition of the slump sale was amended to expand its scope to cover all the forms of transfer. However, inadvertently in the last sentence, there is referred to the word sales instead of the transfer. Therefore, it is proposed to carry out the consequential amendments by amending the provision of clause 42C of section 2 of the Act to substitute the word sales with the word transfer. Clear, my every one of you? Right. So these only the two small amendments we got from the chapter capital gains. Now let us discuss the problems. All the 25 problems we are going to discuss once again. Okay, right. So let us start with the problem number 1, sir. Mr. C purchases a house property for rupees 1,66,000 on May 15th, 1975. Means before the base year. Okay, sir. So if the capital asset was acquired before the base year, what is the cost of acquisition of such capital asset? It is the original cost of acquisition or fair market value as on 1/4/2001, whichever is more beneficial to SSE. What is the base year, ma? Base year is 2001-2. If any capital asset purchased before the base year, then we have cost of acquisition provisions, special provisions, right? You have studied this in the topic fair market value as on 1/4/2001. Right. The following expenses are incurred by him for making addition or alteration to the house property. So that means this is the cost of acquisition and these are all cost of improvement. Any capital expenditure incurred after the acquisition of a capital asset is what we call cost of improvement. And at the same time, we have learned that any cost of improvement expenditure incurred before the base year have to be ignored. Right, sir? So first one, the cost of construction of the first floor in 1982-83, 3,10,000. This is a cost of improvement expenditure incurred before the base year. So this amount should be ignored, Amma. Should be ignored. Should not be considered while calculating the capital gains tax. Next, cost of construction of the second floor. Yes, this have to be considered as cost of improvement. And reconstruction of the property in the year 2013-14. Yes, this is also have to be considered. Okay, now the fair market value of the property as on 1/4/2001 is given 8,50,000. Why this information is given? Because the property was purchased before the base year. So whenever a capital asset purchased before the base year, definitely there will be the information of the fair market value as on 1/4/2020, 2001. Next, the stamp duty value of the property as on 1/4/2001 is rupees 10 lakhs. Good. The house property is sold by Mr. C on August 10, 2022. So the transfer was taken place during the previous year 2022-23 for rupees 68 lakhs, and expenses incurred on transfer 50,000 rupees. Transfer expenses 50,000. Calculate the capital gains for the assessment year 23-24. Means what, Amma? For the previous year 2022-23. Okay, now let us start doing this answer in the notes, Amma. New chapter, capital gains. Problem number one. Problem number one. Calculation of capital gains for the assessment year 2023-24. Particulars, amount in rupees, amount in rupees. So let us start with full value of consideration. How much value the property was sold, Amma? The property was sold for rupees 68 lakhs. 68 lakhs less transfer expenses. Transfer expenses 50,000. So then you'll get net consideration. Net consideration 67 lakh 50,000. 67 lakh 50,000 less. Since it is a long-term capital asset purchased during the year 1975 and sold during the year 2022, so held for more than 2 years, so it is a long-term capital asset. We need to deduct what, Amma? Indexed cost of acquisition. So in order to calculate the indexed cost of acquisition, first of all, we should find out the cost of acquisition. Since the asset was purchased before the base year, the cost of acquisition means to be, you have to take the original cost of acquisition. What is the original cost of acquisition, Amma? The property was acquired for 1,06,000 rupees. The original cost of acquisition, 1,06,000, and this should be compared with the fair market value as on 1/4/2001. What is the fair market value as on 1/4/2001, sir? 8,50,000 rupees. 8,50,000 rupees. So whichever is more beneficial to the assessee, we should take it. So generally, as long as your cost of acquisition is higher, your capital gains amount will be lower. As long as your capital gains amount is lower, your tax liability will be lower. So higher the cost of acquisition, lower the capital gains, lower the tax liability. Hence, we should take the higher cost of acquisition amount. So whichever is higher, we should take. So therefore, we can take the cost of acquisition is equal to 8,50,000. Then immediately you will get a dot here. Sir, in the problem, the stamp duty value as on 1/4/2001 is also given. Why, sir? Sir, whatever the cost of acquisition you find out here, this cost of acquisition amount should be less than or equal to the stamp duty value as on 1/4/2001. This cost of acquisition amount cannot exceed, shall not exceed the stamp duty value amount. Yes or no, sir? Sir, what is the stamp duty value given as in 1/4/2001? 10 lakhs. What is the cost of acquisition you got? 8,50,000, and well within the value of the stamp duty value now? Yes, sir. Okay, you can go ahead with the cost of acquisition of 8,50,000 rupees. Suppose that if we calculated this cost of acquisition and this cost of acquisition, we got answer 11 lakhs. Now you should not take cost of acquisition as 11 lakhs. You should take the cost of acquisition of 10 lakhs only, because this cost of acquisition amount should not exceed the stamp duty value as on 1/4/2001. Okay, na, sir. Right. The cost of acquisition amount you have to take here, amma, 8,50,000 rupees into cost inflation index for the year of transfer, the transfer taken place during the previous year 2022-23, divided by cost inflation index for the base year. The base year is cost inflation index is 100. So 8,50,000 into 331 divided by 100. So you'll get about 28,13,500. 28,13,500. Then less indexed cost of improvement. Excuse me. I'm suffering with the cold since last 2-3 days. Please bear with me. So the cost of improvement, as I said, the cost of improvement expenditure incurred prior to the base year, we should not consider. So you just ignore this 3,10,000 rupees. Next, second time the cost of improvement expenditure incurred during the previous year 2003-4. Yes, this we can consider. So 7,35,000 is the cost of improvement incurred. 7,35,000 into cost inflation index for the year of transfer divided by cost inflation index for the year of incurring that improvement expenditure. And the improvement expenditure incurred during the previous year 2003-4. And what is the cost inflation index, Amma? Just give me a second. So yes, sir, we can take the table here. So for the previous year 2003-4, the cost inflation index is 109. So 109. So calculate, Amma. 7,35,000 into 331 divided by 109. So it will be 22 lakh 31,972. Okay, sir. And we have one more time the cost of improvement. Reconstruction of the property during the year 2013-14, 5,50,000. So again, indexed cost of improvement 5,50,000 into 331 divided by cost inflation index for the year of incurring that cost of improvement expenditure. So the cost of improvement expenditure we have incurred during the previous year 2013-14. And what is the cost inflation index, Amma? The cost inflation index is 220. Okay, sir. So divided by 220. So 5,50,000 into 331 divided by 220. So 8,27,500. So deduct it, sir. You will get the long-term capital gains amount. So long-term capital gains, it would be 67 lakh 50,000 minus 28 lakh 13,500 minus 22 lakh 31,972 minus 8 lakh 27,500. 67 lakh 50,000. So 8 lakh 77,028. 8 lakh 77,028 will be your long-term capital gains. It's showing a different answer. Why, ma? Let us check. We have the answer as well. Yeah. Gross sale consideration 68 lakhs. Net consideration 67 lakh. Yes. The index cost of acquisition, index cost of improvement, index cost of acquisition. How much we got, ma? 26 lakhs 94,500. No, we got a different answer. Why, ma? I think let's check the cross check the calculation part. Note 1, 8 lakh 50,000 into 317. Sorry, Amma. Here it should be 331. It should be 331. 8 lakh 50,000 into 331 divided by 100. So it should be 28 lakh 13,500. Yeah, look at this. The answer taken same 28 lakh 13,500. But here they have taken 26 lakhs 94,500. Make a change, Amma. 28 lakh 13,500. And the index cost of improvement, let us cross check these calculations as well. Yeah, here also they have taken 317. It should be 331. 331. Okay, so 7 lakh 35,000 into 331 divided by 109. So it should be 22 lakhs 31,972. And the second one 5 lakh 50,000 into 331 divided by 220. 8 lakh 27,500. So the total of these two is 30 lakh 59,472. 30 lakh 59,472. So make a correction here. It should be 30 lakh 59,472. The total of both 58 lakh 72,972. 58 lakh 72,972. So the long-term capital gains should be 8 lakh 77,028. 8 lakh 77,028. So while I'm giving the draft, I've given the draft correctly, but I don't know, right? When the material is given for the final editings and everything, they might not have considered my changes. It's okay, no problem. So that's why I'm going to discuss each and every problem in a very detailed manner, sir. Don't worry. You can make these changes in your material. Okay, sir. Now, so that's the answer for the problem number 1, sir. Now moving on to the problem number 2. Problem number 2. Mr. A, an individual carrying on business, his stock and machinery were damaged and destroyed in a fire accident. The value of the stock lost 6,50,000 rupees. The opening written down value of the block as on 1/4/2022, that is the written down value as on 31st of March 2022, after providing for the depreciation 21/22, was 10,80,000. So there was a fire accident taken place in the business premises of Mr. A, and during that fire accident, he had lost the entire stock which is the worth of 6,50,000, and he had lost the plant and machinery worth 10,80,000. During the process of safeguarding the machinery and in the firefighting operations, Mr. A lost his gold chain and a diamond ring, which he had purchased in April 2005 for rupees 1,20,000 rupees. The market value of these two items as on the date of the fire accident 1,80,000. So when the fire accident taken place, Mr. A was there only, and in the process of safeguarding the machinery and the stock, he lost his gold chain and as well as diamond ring. And the worth, he purchased them in 2005 April for rupees 1,20,000. Mr. A received the following amounts from the insurance company towards the loss of stock: 4,80,000. Actually, the value of the stock lost 6,50,000 number, but he received a compensation of only 4,80,000. So that means there is a loss of 1,70,000, which should be treated as a business loss and to be taken into account while calculating your business income. This should be shown as a business loss under the head PGBP only. Stock and trade kada. Next, towards the damage of the machinery, he received only 6 lakhs, but unfortunately we have lost 10,80,000 worth of machinery. 10,80,000 worth of machinery we lost, but we got a compensation of only 6 lakhs. The remaining 4 lakhs should be treated as short-term capital loss. When it comes to the depreciable capital assets, there will be always either a short-term capital gain or a short-term capital loss. Right. Towards the gold chain and diamond ring, right? For this, we need to find out the long-term capital gains or long-term capital loss. Okay, sir. You are requested to briefly comment on the tax treatment of the above three items under the provisions of the Income Tax Act 1961. Already two items I've explained. Only towards the gold chain and diamond ring we have to find out, Amma. So problem number 2. Calculation of long-term capital gains or long-term capital loss with respect to gold chain and diamond ring. Particulars: amount in rupees, amount in rupees, full value of consideration. Here, what do you mean by full value of consideration, Amma? Full value of consideration means to be the amount of the insurance compensation received. Okay, sir. So how much is the amount of the insurance compensation we have received, Amma? We have received a compensation of 1,80,000. So 1,80,000 less transfer expenses. There are no transfer expenses. Then you'll get net consideration less indexed cost of acquisition. These assets were purchased for an amount of 1,20,000 into 331, the cost inflation index up to the year of fire accident. The fire accident taken place, during the previous year 2020 to 23, and so that's why we have taken the cost inflation index as 331, and these were purchased during the year April 2005, means previous year 2005-6. For the previous year 2005-6, the cost inflation index is 117. 117. So divided by 117. 1,20,000 into 331 divided by 117. So it will be 3,39,000 487. 3,39,487. So then you will get the long-term capital loss. It will be 1,59,487. 1,59,487 towards the gold chain and diamond ring. Okay, ma. So let us cross check. So towards the business loss, 1,70,000 correct. Short-term capital loss, 4,80,000. Sorry, 4,80,000 correct. And towards the gold chain and diamond ring, it is given as 145, 128. And if my guess is correct, they might have taken 317. The previous, yeah, as I said now, 317. Make it 331. So 1,20,000 into 331 divided by 117. So it should be 339, 487. So the long-term capital loss should be 1,80,000 minus 339, 487. So 159, 487 will be the long-term capital loss. Okay, ma. That's problem number 2 for you. Check it out, sir. Completed, sir. Now coming to the problem number 3. Problem number 3. ABC Limited converts its capital asset acquired from an amount of rupees 50,000 in June 2003 into stock in trade in the month of November 2019. Conversion of a capital asset into stock in trade amounts to transfer. Do you remember we have discussed the definition of transfer in section number 2, clause 47. Transfer includes conversion of a capital asset into stock in trade. Yes or no, sir? So here that company has converted its capital asset into stock in trade during the previous year 2019-20. So the transfer taken place during the previous year 1920. The fair market value of the asset as on the date of conversion is rupees 4,50,000. The stock in trade was sold for an amount of 6,50,000 in the month of September 2022. What will be the tax treatment? Okay, sir. Now, so let us find out. Here, we need to find out the business income and as well as capital gains. Right. So, problem number 3. First, let us find out the capital gains. Calculation of capital gains for the assessment year 2023-24. Then you will get it out immediately. Sir, the transfer was taken place during the previous year 2019-20 and you are calculating capital gains for the previous year 2023-24. Why? Sir, as per the, whenever a capital asset is converted into stock in trade, the year of transfer will be the year of conversion only. But capital gains should be calculated in the previous year in which such stock in trade was sold out. Right, sir? The year of chargeability is equal to the year in which such stock in trade was sold. Since the stock in trade was sold during the previous year 22-23, we are calculating capital gains for the previous year 22-23. So particulars. amount in rupees, amount in rupees, full value of consideration. What is the full value of consideration in this case? The fair market value as in the date of conversion. What is the fair market value, Amma? The fair market value as in the date of conversion is rupees 4,50,000. So 4,50,000 less transfer expenses nil, net consideration 4,50,000 less indexed cost of acquisition. What is the cost of acquisition? These were purchased for rupees 50,000 in June 2003. So 50,000 into cost inflation index up to the year of conversion. Sir, here indexation benefit is available only up to the year of conversion, not up to the year of stock in trade sold out. Yes or no? Because the stock in trade, capital asset converted into the stock in trade. After its conversion, it is no more a capital asset, it is a stock in trade. So only up to the year of conversion, we have to give the indexation benefit. And what is the year of conversion, ma? These were converted in the year November 2019, means previous year 1920. So only up to the previous year 1920, we have to give the indexation benefit. What is the previous year 1920 indexation factor? 289. 289 into year of acquisition, means the cost inflation index up to the year of acquisition. So up to the year of acquisition, in which previous year the asset was acquired, June 2003, means previous year 2003-4. For 2003-4, it will be 109. So divided by 109. So 50,000 into 289 divided by 109. So you're getting 1,32,569. So you are getting a long-term capital gains of 4,50,000 minus 1,32,569. 3,17,431. This is your long-term capital gains. Now we need to find out the business income as well. You have sold out the stock in trade now, so you need to find out the business income. Calculation of business income. Calculation of business income. Okay, next slide. So sale value of stock in trade. Sale value of the stock in trade. Stock in trade sold for how much, Amma? Stock in trade was sold for an amount of rupees 6,50,000. So 6,50,000 minus minus. So the cost of acquisition of stock in trade. Cost of stock in trade. Sir, what should be taken as the cost of stock in trade here? Whatever the fair market value we have considered for the calculation of capital gains, the same will become the cost while calculating the business income. Yes or no? So here the fair market value as in the rate of conversion will play two roles, Amma. Role number one, it is the full value of consideration while calculating capital gains. Role number two, it is the cost of stock in trade while calculating the business income. So 4,50,000, the cost of stock in trade. So 4,50,000 worth of stock in trade, you have sold for 6,50,000. So you have a business income of, you got a business income of rupees 2 lakhs. So the gross total income, if you calculate, you have a business income of 2 lakhs and you have a long-term capital gains of 3 lakh 17,431. So the gross total income will be 5 lakh 17,431. Okay, ma. So that's the answer for the problem number 3. Problem number 3, gross total income 5,17,431. The same answer we got now. Gross total income 5,17,431. Right, sir? So check it out, sir. So let us check it out in the material as well. Problem number 3. Yeah, here it is. Business income of 2 lakhs, capital gains of 3,17,431, and you have a gross total income of 5,17,431. Completed, sir. Now let's go into the problem number 4. Here it is. Problem number 4. R acquired a property by way of a gift from his father in the previous year 1999 2000. So that means it is an indirect acquisition case. Acquisition of the capital asset by way of a gift, indirect acquisition. So concept of previous owner comes into the picture. Special case. Concept of previous owner. Whenever the concept of previous owner comes into the picture, there are two things comes into picture. Number one, the cost of acquisition to the assessee is equal to cost of acquisition to the previous owner. Number two, while determining the nature of the capital asset, we have to we can also consider the previous owner's period of holding also. While determining the nature only, previous owner period of holding can also be considered. But while calculating the indexation benefit, indexed cost of acquisition, the indexation benefit is given only to the assessee's period of holding. While calculating indexed cost of acquisition, previous owner period of holding should be ignored. Okay, ma. The father had acquired the property in the year 9192 for rupees 1 lakh. Since the asset was acquired prior to the base year, that means prior to 1/4/2001, the fair market value will be comes into the picture. So the fair market value as in 1/4/2001, 2 lakhs, stamp duty value 2,50,000. This property was introduced as a capital contribution to a firm in which R became a partner since the previous year 2022-23. So R joined a partnership firm. So whenever you're joining in a partnership firm as a new partner, you have to introduce your capital contribution. So R contributed this asset as his capital contribution to the partnership firm. The market value of the asset in 22-23 was rupees 10 lakhs, but it was recorded in the books of account for rupees 7 lakhs only. Comment. This is the first question number. So let's do the answer. Problem number 4. Calculation of capital gains for the assessment year 2023-24. Particulars. Amount in rupees. full value of consideration. Full value of consideration. So here, what do you mean by the full value of consideration here? Full value of consideration is equal to the value at which such capital asset was recorded in the books of account of the partnership firm. See, you can see the fair market value as on the date on which the capital asset was given as a capital contribution. The fair market value of the asset is 10 lakhs, but it was recorded in the books of account of the firm for rupees 7 lakhs only. So only the 7 lakhs should be taken as full value of consideration. So full value of consideration is equal to 7 lakhs less transfer expenses nil, net consideration 7 lakhs less indexed cost of acquisition. Indexed cost of acquisition. The asset was acquired before the base year amma. So the fair market value comes into the picture. The fair market value 2 lakhs and stamp duty value 2,50,000. So since the fair market value is well within the limit of stamp duty value, we can go ahead with the fair market value. So 2 lakhs is the indexed cost of acquisition into 331 divided by 100. Cost inflation index for the base year. 2 lakhs into 331 divided by 100. So it will be 6 lakhs 62,000. So you got a long-term capital gain of 38,000. That's the answer, sir. Long-term capital gain 38,000. Check it out. The answer for the first question 38,000. Now look at the second part of the question. This is the second question, Amma. What is your answer if the property was introduced as capital contribution is a personal car used by the assessee? Personal car. Ma personal car antunnadu. It is a personal effect. Personal effect, not a capital asset. Not a capital asset. Since the asset transferred was not a capital asset, there is no question of capital gains. If you have transferred a capital asset, then we need to calculate capital gains. But here you have introduced your personal car as a capital contribution. Hence, there is no transfer of capital asset taken place. No capital gains will be arise. That's the answer. So the answer for the second part of the question, no capital gains. Okay, sir. So that's answer for problem number 4. Check it out, sir. Yeah, here it is. Sales consideration, index cost of acquisition from, I guess, yeah, 331, correctly taken. Thankfully, only for the first 2 problems are few problems, they might not updated, but remaining all the problems updated, sir. But anyhow, all the problems I'll be worked out in the running notes, Amma. You can take down my running notes very happily. So more than enough. Updated one. Okay, Ma. Now come to the problem number 5. Here it is. Problem number 5. A firm consists of 3 partners, namely R, G, and S. 3 partners, Mr. R, Mr. G, and Mr. S. S retires from the firm on 15th of October 2022. His capital balance and profits till the date of retirement stood 15 lakhs. See, when a partner is retiring from the partnership firm, his account should be settled. Yes or no? His capital balance and as well as the profits for that particular year. The total amount should be settled. The total amount comes out to be 15 lakhs rupees. Now, in the settlement of his capital account and the profits, the firm transferred its land, a capital asset, to S in settlement of his account. The fair market value of the land as on the date was 25 lakhs. 25 lakhs worth of land transferred for the settlement of his account. The land was acquired by the firm on 1st of May 2002 for rupees 5 lakhs. Compute the capital gains. Let us start. Problem number 5. Calculation of capital gains for the assessment year 2023, 24. Particulars, amount in rupees, full value of consideration, full value of consideration. What is the full value of consideration here, ma? The fair market value of the asset transferred. So the fair market value 25 lakhs rupees, 25 lakhs less transfer expenses nil. So you will get a net consideration of 25 lakhs less indexed cost of acquisition. First of all, what is the cost of acquisition number? The firm acquired this land for rupees 5 lakhs on 1st of May 2002. 1st of May 2002 means previous year 2002-3. For the previous year 2002-3, the cost inflation index is 105. 5 lakhs into 331 divided by 105. 5 lakhs into 331 divided by 105. So you are getting 15 lakh 76,190. Long-term capital gains 25 lakhs minus 15 lakhs 76,190. 9 lakh 23,810 rupees. 9 lakh 23,810 rupees will be the long-term capital gains taxable in the hands of the partnership firm. Okay, ma. Yes, the answer is different because I guess they have taken a wrong cost inflation index. Let us cross check. Problem number 5. Yeah, it should be 331. 500 into 331 divided by 105. So it should be 15 lakh 76,190. 25 lakhs minus 15 lakh 76,190. So it should be 9 lakh 23,810. 9 lakhs 23,810. Long-term capital gains taxable in the hands of the partnership firm. Okay, ma. So that's why I'm working out each and every answer in the notes. So total we have the 25 problems in this chapter, out of which we have completed 5 problems. So the remaining problems I will explain in the next session, sir. Okay, now till then, have a good day and good night, sir. A very good morning, students. Welcome to the stress taxation classes. We are in the discussion of amendments applicable for May 2023 and November 2023 exams. And in that we have completed the amendments from all the chapters except capital gains. Okay, ma'am. For capital gains also, we have discussed the amendments of the theory part. Only we have 2 amendments. And after that, we started discussion regarding the problems. Here in this chapter of capital gains, we have to discuss each and every problem because there is a change in the cost inflation index. Earlier, the cost inflation index is 317, which is applicable for the previous year 2021-22. But for May 2023 exams and November 2023 exams, the relevant previous year is previous year 2022-23, and for the previous year 2022-23, the relevant cost inflation index is 331. Since there is a change in the cost inflation index, we need to discuss all the problems. Okay, ma. Right. So we have completed already 5 problems. Let us start with the 6th problem, sir. Problem number 6. X acquired a house for rupees 20,000 in the year 1980-81. So here the capital asset was acquired prior to the base year. What is the base year, Amma? Previous year 2021-22. That is the base year. If any capital asset acquired prior to the base year, what happens? The cost of acquisition provisions changes. Here the cost of acquisition is equal to, we have to take the fair market value as on 1/4/2001 or the cost of acquisition, whichever is more beneficial to the assessee. However, whatever the value you are obtaining here, that value shall not exceed stamp duty value as on 1/4/2001. Yes or no? So the fair market value provisions comes into the picture. Right, sir? Every one of you. Next. On his death in October 1995, the house was acquired by his son Y. So in the year 1995, in the month of October, X was died. Now, out of inheritance, the property was taken over by his son, Mr. Y. The market value of the house as on 1/4/2001 was 80,000 rupees, and the stamp duty value as on 1/4/2001 is rupees 70,000. Now you can see here the original cost of acquisition of the asset 20,000 rupees, fair market value as on 1/4/2001 80,000 rupees. Whichever is more beneficial to the assessee and we have to take the higher value, because higher the cost of acquisition, lower will be your capital gains, lower will be your capital gains tax. So the higher value, the fair market value 80,000 rupees, whereas the stamp duty value as on 1/4/2001 is how much, amma? 70,000 rupees only. So here, whatever the value you are obtaining in this step, 80,000 is greater than stamp duty value 70,000. And we have already studied that the value shall not exceed stamp duty value as on 1/4/2001. So that's why your cost of acquisition restricted to 70,000 rupees. Okay, ma, every one of you. Now let's moving on. This house was acquired by the government on 15th of March 2016 for rupees 3 lakhs, and a compensation of 2,20,000 is paid to him on 25th of March 2023, and the balance 80,000 rupees as on 15th of April 2023. Okay, sir. If you look at here, it is a case of compulsory acquisition by the government. So the government was acquired the property, and the acquisition was happened during the previous year 2015-16, right? So this is a year of transfer, previous year 2015-16, and a compensation of rupees 3 lakhs fixed, and we got the compensation of 2,20,000 on 25th of March 2023. That means during the running previous year 2022-23, we have received a compensation of 2,20,000. Only a partial compensation we have received, amount, not the full compensation. But if you look at the provisions of the compulsory acquisition, capital gains are taxable not in the year of transfer, but in the year of receipt of the compensation. Sir, here we have received part of the compensation during the previous year 2022-23 and part of the consideration during the previous year 23-24. Now, which previous year should I tax the capital gains? The answer is you need to calculate the capital gains for the previous year 2022-23, because Whatever the previous year in which you have received the initial compensation, or I can say partial compensation, irrespective of the fact whether you received the full consideration or not, full compensation or not, the year in which you have received the partial compensation, in that year you need to calculate the capital gains. Okay, ma. So that means we need to calculate the capital gains. So for the previous year 2022-23, since we have received a partial compensation. Next, why file a suit against the government challenging the quantum of compensation, and the court ordered for the additional compensation of 1 lakh. He incurred an expenditure of 2000 in this connection with the suit. The additional compensation is received on 14th of March 2024. He also received additional compensation during the previous year 2023-24, right? Okay, and for that purposes he incurred an expenditure of 2000 rupees. Compute the capital gains chargeable to tax. So it's a very simple question, sir. Come to the answer. Problem number 6. Problem number 6. Calculation of capital gains for the previous year 2022-23. This is with respect to original compensation. Original compensation. Particulars. Amount in rupees, amount in rupees. Amount in rupees, amount in rupees. So full value of consideration. What do you mean by the full value of consideration here? Full value of consideration means to be the amount of the compensation. What is the amount of the compensation? 3 lakhs. You will get a doubt here. Sir, 3 lakhs we have not received during the previous year 22-23. During the previous year 2022-23, we have received only 2,20,000. That is what I'm saying, Amma. Irrespective of the fact whether you have received the entire compensation or not, the year in which you have received a partial compensation, for that year, the entire amount of the compensation is taxable. Okay, ma'am. Next, less transfer expenses. Here there is no information of transfer expenses, nil. So you will get a net consideration of 3 lakhs less indexed cost of acquisition. Indexed cost of acquisition. What is the cost of acquisition, Amma? We have already discussed. The cost of acquisition is 70,000 rupees. Since the asset was purchased prior to the base year, and it is also a case of indirect acquisition, section 49(1) provisions comes into the picture. Section 49(1) indirect acquisition, because here assessee, who is assessee, Amma? Mr. Y is the assessee. X was his father. X was died in the year 1995. From his father, Y received the property out of inheritance, out of succession. It is a case of indirect acquisition. 49(1) provisions comes into the picture. And what are the 49(1) provisions? Cost of acquisition to the assessee is equal to cost of acquisition to the previous owner. Now, who is the previous owner? X is the previous owner. What is the cost of acquisition to him? Since he acquired the property prior to the base year, that is 2001-2, the fair market value provisions comes into the picture. So the fair market value as on 1/4/2001 can be taken if it is beneficial to assessee. Sir, you can see the original cost of acquisition 20,000, fair market value 80,000. So fair market value is beneficial to assessee, but we have another provision. The fair market value as on 1/4/2001 shall not exceed the stamp duty value as on 1/4/2001. Since the stamp duty value is 70,000 rupees, we have to restrict our cost of acquisition to 70,000. So the cost of acquisition to X is equal to 70,000. The same become the cost of acquisition to Y. So cost of acquisition is equal to 70,000, for which we need to give the indexation benefit into. Here the indexation benefit is available only up to the year of transfer. What is the year of transfer? You've already decided the year of transfer 2015-16, because during the previous year 2015-16 the government taken over our property under compulsory acquisition. So the indexation benefit is available only up to the year of 2015-16. So we want 2015-16 indexation factor. So for this purpose, let me open that material, amma, or main material. Just give me a second. Yes, sir. Here it is. You can see for the year 2015-16, the cost inflation index is 254. Okay, ma'am. 254 divided by cost inflation index for the base year. What is the base year's cost inflation index, amma? 100. What is the base year, sir? 2001-2. The base year 2001-2 and the cost inflation index is 100. Okay, sir. Now calculate indexed cost of acquisition. 70,000 into 254 divided by 100. You are getting 17 lakhs, sorry, 1,77,800. 1,77,800. Now you are getting long-term capital gains. How much you are getting, sir? Long-term capital gains minus 3 lakhs, 1,22,200. 1,22,200. This is with respect to your original compensation of 3 lakhs. However, Mr. Y is not satisfied with this original compensation. Y also claimed additional compensation of 1 lakh. He filed the case against the government and he won the case. The court ordered the government to pay the additional compensation of 1 lakh. Now let us calculate the capital gains with respect to additional compensation. When he received additional compensation, he received additional compensation on 14th of March 2024. That means previous year 2023-24. Okay, ma. So calculation of capital gains. Calculation of capital gains for the previous year 2023-24. This is for additional compensation. This is for additional compensation. Okay, sir. So particulars, amount in rupees, amount in rupees, amount in rupees, amount in rupees. Then go for the full value of consideration. Full value of consideration. The additional compensation received 1 lakh less transfer expenses. Transfer expenses 2,000 rupees. Then you'll get net consideration. Net consideration 98,000 less indexed cost of acquisition. Here indexed cost of acquisition should be taken as 0 because the cost of acquisition we have already calculated for the original compensation. The cost of acquisition we have already taken for original compensation. So for additional compensation, there will be no more. The cost of acquisition will be available. No more cost of acquisition. Since you have purchased the asset only for one time, you will get the benefit of indexation cost of acquisition benefit only for one time. For additional compensation, there will be no indexed cost of acquisition. The cost of acquisition should be taken as 0. Okay, Nama. So the entire amount you can take it as long-term capital gains. So with respect to Additional compensation, long-term capital gains 98,000. And with respect to original compensation, 1,22,200. Let us see the answers. Yeah, 1,22,200 and 98,000. Clear, sir? Every one of you? Now, this should be treated as previous year. Let's go to the printer solution. Problem number 6. Yeah, here it is. Problem number 6. Make a small change. Make it to this previous year. Here also it is previous year. So 1,22,200 long-term capital gains and 98,000. Okay, sir. So that's the answer. So check it out, sir, and ask the doubts if any. Problem number 6. Completed, sir. Now let's moving on to the next problem. Problem number 7. X purchased a residential plot on 1st of January 1998 for rupees 50 lakhs. So Mr. X purchased a residential plot. Plot means land, only a land, vacant land, on 1st of January 1998 for rupees 50 lakhs. Again, you can see the asset was acquired prior to the base year 2001-2. So the fair market value provisions comes into the picture. The fair market value of the plot as on 1/4/2001 is rupees 65 lakhs and the stamp duty value as on 1/4/2001 as 68 lakhs. So the original cost of acquisition 50 lakhs, fair market value 65 lakhs. Whichever is more beneficial to SSE. So whichever is higher, you can take 65 lakhs. And whatever the value we are getting here, the value is less than stamp duty value as on 1/4/2001. So therefore, we can take the cost of acquisition as 65 lakhs. Are you following, sir? Every one of you. 65 lakhs as our cost of acquisition. Moving on. Alpha Builder enters into a development agreement with Mr. X on 1st of May 2020 on the following terms and conditions. Mr. X will hand over the property to Alpha Builders on 1st of May 2020. Alpha Builders will pay a check of rupees 60 lakhs to Mr. X on 1st of May 2020. Right? And Alpha Builders will construct 10 residential units on the plot of land and will give 6 units to Mr. X. The 10 units shall be completed by 30th June 2021 and on that date, 6 units will be handed over to Mr. X. This is a case of, joint development agreements, JDA, joint development agreements. Section 45(5)(a) comes into the pictures. Section 45(5)(a), right? So here X transferring his plot of land to Alpha Builders. The Alpha Builders constructing 10 units in this plot of land. 10 units. And out of the 10 units, 6 units will be given to X. Why, sir? Because X is giving the land, na? X is owner of the land. He's transferring the ownership in the land to the builders. For transferring his ownership on the land to the builders for the development, X expects some consideration in return. And the consideration is Alpha Builders paying a check of 60 lakhs immediately on transferring the possession of the land. And apart from that, 6 units were also allocated immediately after the completion of construction. So here, X receiving the compensation of consideration of 60 lakhs rupees by way of check and 6 units. 1, 2, 3, 4, 5, 6. 6 units. This is a consideration received by X on transferring the land to Alpha Builders. Okay, ma. The stamp duty value of the plot as on 1/5/2020 is 2 crores. And the stamp duty value of the each flat as on 30th June 2021 is rupees 45 lakhs. Okay. The project completion certificate is issued by the competent authority on 30th June 2021 and 6 units are handed over to Mr. X on 30th June 2021. So once the project gets completed, that means the construction of all the 6 units, all the 10 units completed, then we need to take a completion certificate from the competent authorities. Means municipal authorities or registered engineers. Okay, now, right? Next. The project completion certificate is issued by the competent authority on 30th of April 2022. And on that date, the stamp duty value of the each flat is 50 lakhs. 6 units are handed over to Mr. X on 30th of April 2022. So there are two cases. Case number 1, the project was completed during 30th June 2021. And as on that particular date, the stamp duty value of the each flat is 50 lakhs. Second case, the project completion certificate we have received on 30th of April 2022. As on date, the stamp duty value of the each flat is 50 lakhs. Now, in these two cases, we are asked to find out the capital gains. Okay, ma. So let us start doing the answer. Let us start, sir. Problem number 7. Calculation of capital gains for the assessment year. Sir, as per the provisions of section 45(5)(a), here you can see the year of transfer is the year in which the possession of the land transfers. Sir, when the possession was transferred, the possession was transferred on 1st of May 2020. That means previous year 2020-21. Previous year 2020-21. Now this is what we called year of transfer. But as per the provisions of section 45(5)(a), the capital gains are taxable not in the year of transfer. The capital gains are taxable in the year in which you have received the completion certificate from the competent authority. Sir, when you have received the completion certificate in the case number 1, it is 30th June 2021. 30th June 2021. That means previous year 2021-22. Now this is year of chargeability. Year of chargeability, the year in which the capital gains are taxable. So previous year 21-22 means assessment year 22-23. This is for case 1. Okay, sir. This is for case 1. So particulars, amount in rupees, amount in rupees. Full value of consideration. Full value of consideration. What do you mean by the full value of consideration here? I've already told you the amount of the consideration received in kind plus the amount of the consideration received in cash. In check, you have received a consideration of rupees 60 lakhs plus the amount of the consideration received in kind. Totally 6 flats you have received. 6 flats you have received, and the stamp duty value as in the date of receipt of the completion certificate. When you have received the completion certificate, 30th June 2021. As on that, what is the stamp duty value? 45 lakhs into 45 lakhs. How much you are getting, sir? 45 lakhs into 6 plus 60 lakhs, 3 crores, 30 lakhs. 3 crores, 30 lakhs. This is your full value of consideration. Less transfer expenses. Transfer expenses, nil. Net consideration, 3 crores, 30 lakhs. Less indexed cost of acquisition. And in order to find out the indexed cost of acquisition, first we should find the cost of acquisition. What is the cost of acquisition, Amma? The cost of acquisition is, we've already discussed earlier, it is 65 lakhs rupees. 65 lakhs cost of acquisition into cost inflation index up to the year of transfer. एक डोर बंद कीजिए. Cost inflation index up to the year of transfer. Sunlight आ रही है वहां से. Up to the year of transfer. What is the year of transfer? The year of transfer is the previous year 2020-21. For the previous year 2020-21, what is the cost inflation index? You can see here for the previous year 2020-21, the cost inflation index is 301. So 301 divided by 100. So 65 lakhs into 301 divided by 100. So you're getting, sir, 1 crore 95 lakhs 65,000. So you are getting a long-term capital gains of 1 crore 34 lakh 35,000. 1 crore 34 lakh 35,000. This is the answer for case 1. 1 crore 34 lakh 35,000. Okay, ma. Now similarly for the case 2. Case 2. Calculation of capital gains for the assessment year. So for the case 2, the previous year is previous year 2022-23. Previous year 22-23. Means assessment year 23-24. Assessment year 2023-24. Particulars. Amount in rupees, amount in rupees. Particulars, amount in rupees, amount in rupees. So full value of consideration. Full value of consideration. Same, the amount of the consideration received in cash plus the amount of consideration received in kind. The amount of the consideration received in cash 60 lakhs plus the amount of the consideration received in kind. Totally 6 flats. 6 flats we have received amount 6 flats into, and we need to take now the stamp duty value as in the date of receipt of the completion certificate from the competent authority. So you can see here we have received the completion certificate on 30th of April 2022. As on date, the stamp duty value is 50 lakhs for each flat into 50 lakhs. So this will give you 3 crores 60 lakhs. 3 crores 60 lakhs less transfer expenses, transfer expenses nil, net consideration 3 crores 60 lakhs less indexed cost of acquisition. There is no change in the indexed cost of acquisition. Same answer. It will remain summa 65 lakhs your cost of acquisition into 301 divided by 100. It remains to be same 195 65 1 crore 95 lakh 65,000. Then the long-term capital gains. Long-term capital gains 3 crore 60 lakhs minus 1 crore 95 lakhs 65,000. That will give you 1 crore 64 lakhs 1 crore 64 lakhs 35,000. 1 crore 64 lakh 35,000. This will be your answer, Amma. Check it out. 1 crore 64 lakh 35,000. Okay, sir. Right. So look at the printer solution, sir. Yeah, here it is. For the assessment year 22-23, the long-term capital gains taxable 1 crore 34 lakh 35,000. And for assessment year 23-24, the long-term capital gains taxable 1 crore 64 lakh 35,000. Clear, sir? This is the answer for the problem number 7. Okay, now, so just go through it and ask the doubts if any, sir. Completed, sir, everyone. Now let's moving on to the next problem. Problem number 8. Singani and Company owns 6 machines put in use for business in March 2021. The depreciation on these machines is charged at the rate of 15%. The return on value of these machines after providing depreciation for 21-22 was 8,50,000 rupees. Right, sir. So that means the closing return on value for the previous year 2021-22 was 8,50,000, which means the opening return on value for the previous year 22-23 is 8,50,000. 3 of the old machines were sold on 10th of June 2022 for rupees 11 lakhs. A new plant was bought for 8,50,000 on 30th November 2022. You are required to determine the claim of depreciation for the assessment year 23-24. Compute the capital gains liable to tax for the assessment year 23-24. And we will see the point number C later. So section number 50 provisions comes into this picture. Sale of depreciable capital assets. So let us start with the problem number 8. Calculation of capital gains for the assessment year 2023-24. Calculation of capital gains for the assessment year 2023-24. Particulars. Amount in rupees, amount in rupees. amount in rupees, amount in rupees, full value of consideration, full value of consideration. So first of all, the first question is about the depreciation. No, sorry, calculation of depreciation. Calculation of depreciation for the assessment year 23-24. So opening return on value of the block, opening return on value of the block. So totally, how many missions we are having, Uma? We are having 6 missions, and the opening return on value 8,50,000. 6 missions we are having 8,50,000. Number of missions, amount in rupees, for which add cost of additions made during the previous year. Cost of additions made during the previous year. During the previous year, we have purchased one asset, right, sir? A new plant was purchased, 8,50,000 on 30th November 2022, which is put to use for less than 180 days. Since you purchased on 30th November 2022, that means during the current previous year, you hardly used it for how many months, Amma? You hardly used it for only 4 months. December, January, February, March. 4 months and maximum 120 days. So less than 180 days. Less than 180 days. If an asset is purchased and put to use for less than 180 days, only half of the depreciation will be allowed, Amma. That we will see later. So 8,50,000, the cost of the new asset. Total, we are having 7 machines and the block value 17 lakhs less sale proceeds of the assets sold during the previous year. Totally 3 machines we have sold for 11 lakhs rupees. Am I right? 3 machines we have sold for 11 lakhs rupees. Yeah. 3 of the old machines sold for rupees 11 lakhs. Right, sir. Now, the total number of the assets left in the block 4 and the block value 6 lakhs. This is what we call depreciable value. Depreciable value. Totally, we have 4 machines and the value of the block left is 6 lakhs. Now, less current year depreciation. Less current year depreciation. So the block value you have 6 lakhs into rate of depreciation for this block 15% into 1 by 2. Sir, why 1 by 2? So whatever the block value left here, the block value is lower than the cost of the new asset. Since the block value is lower than the cost of the new asset, the entire depreciable value, the entire block value is to be treated as the cost of the new asset only. The entire amount of this 6 lakhs to be treated as the cost of new asset only. Since the new asset is put to use for less than 180 days, only half depreciation is allowable. So 6 lakhs into 15%, 90,000 into 1 by 2, 45,000. Current year depreciation, how much, Amma? 45,000. So the closing return on value, closing return on value as on 31st of March 2023. 31st of March 2023. Totally, you have 4 machines left and the block value 5,55,000. Okay, sir. So in the first question, we were asked to find out the depreciation for the assessment year 2023-24, and this is the answer 45,000. Check it out. The claim of depreciation, actually he has given the block value into 15 percentage into 1 by 2, you can say 45,000. 45,000 in the printed solution, you have the answer 45,000, or else you can change here itself 45,000. Now look at the second question. Compute the capital gains tax for the assessment year 2023-24. Capital gains not applicable. Not applicable because we have already discussed section 50 and section 32, both are mutually exclusive sections. Mutually exclusive sections. For any particular situation, if section 32 provisions are applicable, for the same situation, section 50 provisions are not applicable. Either section 50 or section 32, only one section can be applicable for that situation at a time. Since in the given case, depreciation provisions are applied, section 50 provisions cannot be applied. Both are mutually exclusive. Section 50 comes into the picture only when section 32 not applicable. Yes or no? Right, sir. So capital gains does not arise. The answer for the second question. Look at the third question. If Singhania and Company had sold the 3 machines in June 2022 for rupees 21 lakhs. Earlier we given with the information 11 lakhs. Now they said 21 lakhs. Will there be any difference in your above workings? Explain. Answer absolutely yes. The difference will be there. What is the difference? Let me explain you with the help of the notes. C point. Calculation of depreciation for the assessment year 2023-24. Particulars, amount in rupees, sorry, number of machines and amount in rupees. Number of machines and amount of rupees. Opening return on value of the block. Opening return on value of the block. Totally we have 6 machines worth 8,50,000. Add cost of additions made during the previous year. Cost of additions made during the previous year. We have purchased one machinery worth 8,50,000. Totally 7 machines we are having for 17 lakhs. Less sale proceeds of the assets sold during the previous year. Totally 3 machines we have sold for 21 lakhs. We left over 4 assets in the block, but the value for the block is nil. The value for the block is nil. You should not take 17 minus 21 minus 4 lakhs. The block value cannot be negative. Block value cannot be negative. The block value either 0 or positive. Yes or no? Now, in this scenario, whether section 32 provisions are not applicable, whether section 32 provisions are applicable, answer is no, not applicable. In order to apply the section 32 provisions, there are 2 conditions to be satisfied. First condition, there should be at least one asset in the block. At least one asset in the block. We have 4 assets, so this condition satisfied. And condition number 2, there should be some value for the block. There should be some value for the block. And what is the value of the block? 0. So this condition not satisfied. Since one of the conditions are not satisfied, section 32 provisions are not applicable. Section 32 provisions are not applicable. Hence, section 50 provisions are comes into the picture. So we should calculate capital gains. Calculation of capital gains. Calculation of capital gains for the assessment year 2023-24. For the assessment year 2023-24. So you can take the full value of consideration. The assets are sold for 21 lakhs minus opening return on value of the block. Opening return on value of the block 8,50,000 minus cost of additions made during the previous year. 8,50,000. Both put together. So the short-term capital gains you are getting how much, Amma? Short-term capital gains 4 lakhs rupees. So 17 lakhs worth of block you have sold for 21 lakhs. So you have a capital gains of 4 lakhs. And in the case of depreciable capital assets, there will be either a short-term capital gain or a short-term capital loss. Yes or no? So you have a gain of 4 lakhs rupees, sir. That's the answer for problem number 8. So check it out, Amma. Short-term capital gains 4 lakhs. Clear, sir? So just go through it once. Problem number 8. Yeah, here it is. The written down value of the block, you got 6 lakhs rupees and the depreciation 45,000. That's answer for question number A. Question number B, there will be no capital gains. Capital gains will not arise as the block of assets continue to exist. And some of the assets are sold for a price which is lesser than the written down value of the block. So there are assets exist in the block and there is some value for the block. That is why we are calculated depreciation. And as long as depreciation provisions are applicable, capital gains provisions are not applicable. And in the third case, you can see short-term capital gains 4 lakhs rupees. That's the answer. Check it out, sir. Completed, sir. Now let's moving on to the problem number 9. Problem number 9. Mr. A is a proprietor of Akash Enterprises having 2 units. He transferred on 1st of April 2022 his unit 1 by way of slump sale for a total consideration of 25 lakhs. So Mr. A is having one enterprises, Akash Enterprises, which is consisting of 2 units. Out of the 2 units, he sold 1 unit. He sold, sorry, Amma. He sold 1 unit, unit 1, by way of slump sale for a total consideration of 25 lakhs. Okay, Ma. Section 50 capital B provisions comes into the picture. Slump sale. And he sold for a consideration of 25 lakhs. The fair market value of the unit as on 1/4/2022 is rupees 30 lakhs. Okay. Unit 1 was transferred, started in the year 2005-6. The expenses incurred for this transfer were 28 lakhs. Transfer expenses given him 28 lakhs. His balance sheet as on 31st of March 2022 is as under. So balance sheet is given, sir. Liabilities, own capital, revaluation reserve for the building of unit 1, bank loan out of the total amount of 2 lakhs, 70% is for unit 1, trade creditors 1,50,000, out of which 25% is for unit 1, and assets, buildings, machinery, debtors, and other assets. Other information, revaluation reserve is created by revising upward the value of the building of unit 1. So unit 1 building value, whatever is at 12 lakhs, this is after upward revaluation. Right, sir? You can see the revaluation reserve is created by revising upward the value of the building of unit 1. Basically, revalued figures we should not consider them. Revalued figures. Yes or no? Right? Next. So when it comes to the depreciable capital assets, we have to take the return on values. When it comes to the non-depreciable capital assets, we have to take the book values while calculating the net worth. Yes or no? Revalued figures should not be considered. Next. No individual value of any asset is considered for the transfer deed. That is why it is called slump sale. Slump sale means what? Transfer of a business unit as a whole or a business undertaking as a whole for a lump sum consideration without assigning the values to individual assets. That is what we call slump sale. Next, Other assets of Unit 1 includes patents acquired on 1st of July 2020 for rupees 50,000 on which no depreciation has been charged. Other assets. In this, patents also included worth rupees 50,000, but patents were depreciable capital assets now. The rate of depreciation applicable 25%. We have to take the return on value, but the depreciation has not been charged under. Don't worry, we will charge. Okay. Next, compute the capital gains for the assessment year 2023-24. Okay, ma. Let us start with problem number 9. Problem number 9. Calculation of capital gains. Calculation of capital gains for the assessment year 2023-24. 2022-23-24. Particulars. Amount in rupees. Amount in rupees. Full value of consideration. Full value of consideration. Sir, here the unit 1 sold for rupees 25 lakhs. However, the fair market value of the unit is given 30 lakhs. Now, which one should I take as my full value of consideration? Here only we got the amendment. You remember, sir? Here only we got the amendment. Let me take to the amendment. In this chapter only we have discussed. Yes. Deemed full value of consideration. This is amendment. The fair market value of the capital assets as in the date of transfer calculated in the prescribed manner shall be deemed to be the full value of consideration received or accruing as a result of the transfer of such capital asset. Right, sir. Accordingly, the CBDT has prescribed for the purpose of section 50B2, the fair market value of the capital assets would be the higher of fair market value 1 being the fair market value of the capital assets transferred by way of slump sale, and fair market value 2 being the fair market value of the consideration, which including monetary and non-monetary. So the fair market value of the unit shall be taken as full value of consideration here. Are you following, sir? Every one of you. So the full value of consideration you have to take here as 30 lakhs less transfer expenses. How much transfer expenses given, sir? Transfer expenses given 28,000 rupees. 28,000. So net consideration 29 lakh 72,000. 29 lakh 72,000 less indexed cost of acquisition. Here basically what we will take about net worth of the unit 1 as the cost of acquisition. Net worth, right, sir? This we will calculate in the working notes, and if you deduct it you will get a capital gains, long-term capital gains, because the unit was established in the year 2005-6 and sold during the year previous year 22-23. Since the unit was held for more than 3 years, that means more than 36 months, it is a long-term capital asset. So whatever the resultant gains or losses we are going to get, long-term capital gains or long-term capital losses. Okay, ma. Now here cost of acquisition should be taken as your net worth only. What do you mean by net worth? Current assets minus current liabilities. That we will calculate in the working notes only. Working notes number 1. Calculation of net worth Calculation of net worth. First, let us take the current assets. Current assets. Let us see one by one. First one, sorry, ma, the answer is it should be the total assets minus total liabilities, not current assets. Total assets minus total liabilities will give you the net worth. And total assets first one, buildings. Actually given 12 lakhs amma, but revalued figures shall not be taken. So 3 lakhs, the upward revaluation value should be deducted, right? So the building value you have to take only 9 lakhs. This upward revaluation value should be deducted. Machinery 3 lakhs, debtors 1 lakh. Machinery 3 lakhs, debtors 1 lakh. Other assets, other assets. How much of other assets you are having? Other assets of unit 1 lakh 50,000, out of which 50,000 is your patents under. So the patent value should be deducted. That we will be add after calculating its depreciation and its return on value. So for the timing, other assets you have to take out of the 1 lakh 50,000, 50,000 patent value deduct amount. So the other assets value 1 lakh. Now patents, take them separately. Patents, take them separately. This we will calculate in the working notes number 2. This will give you what amount? Total assets less total liabilities, less total liabilities, total liabilities. So look at the liability summa. Revaluation reserve shall not be taken. Own capital not to be taken. Bank loan. Bank loan. 2 lakhs is a total amount, out of which 70% only with respect to unit 1. 1 lakh 40,000. And trade creditors 1 lakh 50,000. Creditors 1 lakh 50,000, out of which only 25% is belonging to unit 1. 1 lakh 50,000 into 25%. 37,500. This will give you the net worth under. So for the net worth calculation, first we should find out the return on value of the patents. Working notes number 2. Working notes number 2. Calculation of return on value of patents as on 1/4/2022. Original cost. When the patents were acquired, the patents were acquired on 1st of July 2020 for 50,000. Acquired during the previous year, 2020-21, for rupees 50,000 minus depreciation at the rate of 25%. Patents, intangible assets. For intangible assets, the rate of depreciation 25%. Yes or no? So this is for the previous year, 2020-21. For the previous year, 2020-21. 50,000 into 25%, which comes out to be 12,500. 37,500. This is return on value as on 31st March 2021 minus depreciation at the rate of 25% for the previous year 2021 22, 37,500 into 25 percentage, 9,375. Deduct amma, you will get 28,125. This is return on value as on 31st March 2022. So that means the opening return on value for 1/4/2022 is 28,125. 28,125. So the total value of the assets 9 lakhs plus 3 lakhs plus 1 lakh plus 1 lakh plus 28,125. So 14,28,125 is the total value of the assets minus total value of liabilities 1,40,000 minus 37,500. 12,50,625. 12,50,625. This is the net worth, which will be the cost of acquisition for slum sale. 12,50,625. Now the capital gains. 17,21,000. 17,21,375. 17,21,375. That's the answer for problem number 9. Check it out, Amma. 17,21,375. Got the answer, sir? Every one of you? The same answer we got now, 17,21,375. So check it out in the printer solution. Here it is. Just go through it and ask the doubts if any. Completed, sir, everyone? Right. So we'll discuss the remaining problems in the next session, sir. Till then, have a good day and good night.